Scale of the gains that we've been seeing. But to your point, ASML was up 8% yesterday on this TSMC story, plus the Morgan Stanley upgrade, really giving that stock a huge boost. So here we go. European equities are about to open Thursday, the 6th of June. What kind of a market story are we going to see into the ECB meeting a little bit later on around lunchtime? Here we go. We're going to start to see trading unfolding in front of us. And initially, Novo Nordisk looks like it's popping higher as well, just in terms of the percentage gains. That's fascinating. So it already is adding by far and away the bulk of the points gains. Novo Nordisk and ASML, there you go. Those are the two biggest stocks in Europe, and they are leading in terms of points, understandably. But the percentage gains are pretty strong as well. Can I just throw in the fact as well that the third biggest points gainer this morning is LVMH, but that's not useful. Only the first two.
Here's another redhead also, just switching focus to the energy story. Do you remember when the traders at Trafigura were just minting cash during the crisis in Ukraine? Well, half-year profit, this is redhead on the terminal right now, Trafigura half-year profit dropping 73% as the energy crisis fades. Bad news for traders there, good news for the rest of us in terms of inflation, of course. So, yes, technology, healthcare, tech, still the leading sectors. The upside coming through 0.5%. And again, we're talking about the ECB, the cut that's expected to come through today, and what that could mean for European equities as the rally continues.
Absolutely. There's probably some ex-divs in the market as well, so I'm just going to be a little cautious when we come to the downside as to what is happening. But it is interesting that we talk about the kind of the Magnificent Seven and the impact that they are having here over in the United States. Here in Europe, I am confounded. I continue to be confounded just by the kind of the scale of the impact that these small group of stocks are having. LVMH, not LVMH, Novo Nordisk, ASML, Schneider's on the list as well. It's up quite strongly again this morning. So you've got these big stocks, these big kind of impact stocks really having that impact today. And it's interesting so what kind of trading is going on? This feels like this feels like the story that we were watching recently, which is the passive money just pouring into these kinds of stocks. And that looks like it is the kind of the momentum story here in Europe, and it doesn't look like it's letting up anytime soon.
You flagged that Remy might be a mover, and it is up there as one of the key gainers, the top gainers so far in the session, up 3.5%. The top line was that they actually beat in terms of their earnings. There's still a challenge in terms of the demand picture, as you mentioned, around the US. They've seen some improvements in the Chinese market. Top line is they beat, and Remy is now the leading gainer. So far, early doors, of course, in terms of the European session, up 4% so far on Remy, just shy of 4%.
It's ECB day. Yeah, that's what we're watching today. That's the big story that we're going to be watching for a little bit later on. Connor Cooper from Bloomberg's MLive blog sitting next to us now. What do you expect? I'm getting excited about this. Should I be?
Not about the rate decision, no.
No, we know that's coming, but what comes next?
So what next? Is this a central bank that's keen to cut rates again, or is this a cut-and-wait approach from the ECB? The way market pricing is, the ECB is going to cut today, they're going to pause in July. That's not a bad position for the ECB to be in. It means they can wait till September to get 3 months more of data, wage numbers, which we're told are really important. They can regroup. So it's probably going to be a boring, data-dependent message from Lagarde. I imagine any questions on where rates go next will be pushed away with data-dependent. I
can't believe you just put a cap on Guy Johnson's excitement around the ECB.
I think that's quite interesting, because I wonder how will the market perceive that as being hawkish. Is this a hawkish cut, I guess, is maybe... You read into that as being a hawkish cut, right?
Yeah, and whether or not, again, you've talked about the potential volatility around the euro on the back of that. When it comes to the Fed, then, we've had ADP data, services came in strong, the jobs market does seem to be cooling, manufacturing is cooling, we have non-farm payrolls on Friday, of course, and how that builds into the picture. where are we in terms of the market's now pricing in, almost fully pricing in 2 cuts now from the Fed?
Yeah, I was checking this morning. There's 48 basis points for cuts priced in for this year. It was 30 basis points last week. It started with that downward revision to first quarter GDP. We had a miss in JOLTS, a miss in ISM manufacturing. Services did beat, but prices paid tick lower. And if you look at the market reaction from yesterday, yield shot higher on the headline number, but then they saw the prices paid and we come lower again. So Fed goes into this meeting with data sort of on the turn lower. I don't think they've made their mind up yet because we have payrolls tomorrow and we have CPI on Fed Day as well. So I don't think that will change if we get a rate cut or not from the Fed. I do think they'll be on hold. The messaging, I think, will depend on the jobs number tomorrow and the CPI data we get a few hours before the Fed.
Are equity markets responding to the idea that rates are coming lower? Because I found it really... Equity markets continue to go higher when we were pricing out cuts, so why should they go higher when we price some of those cuts back? I'm finding this slightly difficult to understand.
I had the same theory. I mean, there's no stopping Nvidia at the moment. No. US stocks, they look like they're going along for the ride. Record highs for both the indexes yesterday. It takes a brave person to call when this euphoria will sort of end. Nvidia don't seem to be stopping. They had a new product announcement just this weekend, I think. Yeah. And like you said, in the pipeline is accommodative monetary policy. This is a stock that's gone sort of parabolic during the most aggressive hiking cycle, or one of in history.
It's amazing.
It's kept on going where rates have stayed high. I don't think more accommodative policy is going to be the catalyst for a lower move for Nvidia.
And Goldman Sachs, interestingly, talking about the cash that's on the sidelines and how typically that gets put to play over the summer months. What derails this rally, though?
Maybe does the Fed go too far? I don't think we'll know this until after the fact, which is a problem for the Fed. There might be a concern that the Fed's sort of too aggressive, inflation comes too low and sort of derails the recovery.
If the dot plots and the forecasts come in at 1 from 3 to 1, does that challenge the equity markets, or do the stocks just look through that as well?
Again, stocks have rallied, like I said, during the most aggressive hiking cycle in history, and they've still rallied when we've held it there. I mean, when they was predicting this aggressive path of rate cuts, everyone was calling it the sort of death knell for equities, but they kept on going, and now they've got these sort of the Nvidia AI catalyst to carry it on. So I think unless the Fed goes ultra aggressive on raising rates again, if inflation re-accelerates, I think the path is still high for stocks.
Yeah. It's interesting that the bond market's maybe seeing the world, starting to see the world a little bit differently. That relationship's going to be fascinating to watch. Great stuff, Connor. Nice to see you. Thanks very much indeed. Connor Cooper joining us from our MLive blog. Let's talk about Remy. Let's talk about what's happening in the drinks business. Remy Cointreau shares gaining this morning. Decent bounce, as you can see, up by over 4%. The French cognac maker beating estimates on full-year operating income. Says it's going to take another year, though, to return to growth. The initial headlines I saw this morning, I have to say the initial read looked a little bit more downbeat. It's going to take a while longer to get things back on track, but actually maybe doing a little bit better than anticipated. With the current numbers is enough to drive the stock. It's been moving lower, obviously, for a while. Duncan Fox from Bloomberg Intelligence joins us now. Look, what have I learned today that justifies the bounce, and what happens next? This still feels like it's a company that is in cautious mode.
It is, but it's looking for the long term, and it's confirmed its sort of 2029, 2030 guidance, where gross margins up at 73% and net margins considerably higher than they are today. So I think that was very important. And you've got to remember the shares have been hammered this year so far as well. I think it's about 26, 27% down on the year. So there's a relief that it's not worse than expected, part one. And two, if interest rates start to go down in the discussion you just had, that would be very good news for the US business, because if you're a distributor, it's quite an expensive thing to buy a couple of cases, many cases of this cognac. So for the working capital side. Exactly. So I think interest rates coming down would be a big help for this company in the US, which is a very, very big market for them.
Yeah, okay, so we're tying the corporate and consumer story back to the rate story. Which of the regions is most essential to them right now? Whether it's China, there seems to have been made some progress in terms of cutting costs in that region, but the US marketing cost is a factor there. Which of those regions is most consequential, do you think, in the quarters ahead?
I think the US is the one that would matter most, because once you've got rid of the inventory from the system, then you should start to see people buy cocktails again if the consumers are confident enough to do that, and that will drive organic growth of the company. China is, they sell a lot of very expensive product into China, but they sort of got that where they needed to be. The only issue they've got there now might be if the Chinese anti-dumping program on cognac, brandy, comes back to bite them. But I think that's more political than actual, to be honest with you. But not good enough to quote on that one.
Be interesting to see what a Trump presidency could mean for the sector as well. Duncan, nice to speak to you. Thanks very much indeed for dropping by. Duncan Fox joining us from Bloomberg Intelligence on the REMI numbers. Let's take a look at what is happening with the Core 6 this morning. We've already talked about the fact that some of these stocks seem to be getting a decent bounce, and as you can see, it really is writ large across the board in front of you. Novo's up really strongly, pushing higher again. I think it's a fresh record there. The less than useful LVMH, I joke, of course it is useful, but it sits next to, well, near to ASML. A Ferrari's useful, Tom?
Oh, Ferrari's definitely fit the usability. How many Birkins do you have now in the Guy Johnson collection? In that
three or four, but
3 or 4 Birkins,
I park them next to my Ferraris.
Keeping them in Ferraris,
We did obviously have the Danish market closed yesterday. I think Sweden's closed today, so just bear that in mind as well. So that market was closed yesterday. Schneider's up really nicely as well, but look, Nestle, a little softer today, which I think is interesting. But ASML continues to pound.
Yeah.
It was up, 8% yesterday. It's up another 2.5% today.
Yeah, that is not a small move that we saw yesterday. There's no profit-taking going on right now. We're adding to the gains, closing in on €1,000, up 2.4%. This is a stock that's rallied more than 40% year to date. And the key piece of news that seemed to come through, yes, there was an upgrade. That was a factor, but also the news that TSMC, which of course owns these foundries, will be taking shipment of one of the most high-tech lithography machines that ASML produces with a price tag of above €300 million. So that's number 2 for them. They have Intel taking charge of one, taking ownership of one, and then TSMC. And the broader outlook then is you push into 2025 with Bloomberg Intelligence seeing that adds just for this year €700 million potentially for this company, and you look ahead to 2025, which the company had already said was going to turn more positive in terms of demand. So that story continues for ASML.
Remy, I'm just going through the usefulness scale here. Remy, useful there. It seems to be
in moments of crisis, moments of pleasure and joy. Yeah, it has a utility, doesn't it? I think. Is it too early to talk about?
No, I definitely don't think it is. But Remy's up nicely, nearly 4%. It's off its earlier highs, but yeah, the numbers look fairly good this morning. But remember, this is a stock that has had a fairly difficult run recently. Yeah. So you've got to kind of put it in the context of kind of where we are, which is why I think the bounce this morning in ASML is kind of amazing, considering this is off an 8% bounce yesterday. So that stock continues to deliver on day 2, day 3, day 4. It's amazing.
I now have an image of you with your Ferrari parked outside the villa in Surrey with that case of cognac and the Birkin bags, Guy Johnson.
You know me so well.
We're talking about the FTSE 100 reshuffle. Well, that's happening today. Bit of a blow for Ocado, but maybe a little bit of upside for some real estate companies. So the reshuffle, quarterly reshuffle, kicking in today. UK landlord London Metric, cybersecurity firm Darktrace, and home builder Vistry are being promoted to the top benchmark. Meanwhile, Ocado, as I mentioned, getting relegated into the relegation zone to the FTSE 250 for the first time in 6 years. Along with them, wealth manager at St James's Place, which has had its own challenges, of course, this year, and electronic components maker RS Group. For more, we are joined by Morwenna Coniam from Bloomberg Markets Today blog. Morwenna, talk us about some of these moves and what it tells us maybe about some of the idiosyncratic stories within these individual companies.
Yes, so it is an interesting selection of companies. I think London Metric, the UK landlord, that has really been helped by their takeover of a rival this year. And that's actually seen its market cap almost double, which of course puts it within the catchment area, so to speak, for the FTSE 100. Then if you look at something like Ocado, I don't think there's any surprise that it has been moved down because it's actually lost about 50% of its share price in the last year. But there is an interesting question with Ocado in the way that it's been valued. So investors have been disappointed in how it's got new contracts for its warehouses, but it's also been valued as kind of as a grocer in the UK. Some people would like it to be seen more as a tech company, so that's always been a bit of a controversial stock for the UK. Then looking at other stocks that are moving, we've got Vistry, which is a home builder. Now that's an interesting one because it's basically going up because they think there's better signs of growth in the UK housing market. But of course we know that that's quite volatile. We also have an election coming up this year, so those stocks that are impacted by macro factors, whether they manage to retain that growth is up.
So how much? Okay, so to balance those two things out for me, how much of this is about idiosyncratic single stock stories that are moving these stocks in and out of the FTSE 100, and how much of it's this kind of broader trend as to what is happening in the market?
I would say most of them are actually quite idiosyncratic. If you look at things like St James's Place, they have had, very well publicised difficulties, and that's. But although they've also been benefiting actually recently from increased inflows since they've sorted some of them out, but it is too late for the shares, so to speak. And then you've also got RV, that is more of a sector-wide issue with supplies, and Dark Trace, that's again
cybersecurity being taken over?
Yes, so that's actually a really interesting one because it's although it is entering now, it has been agreed to be taken over. So
is it entering because it's got a premium because of the takeover?
Well, it has risen because of that. So I think it'll be interesting to see what happens next time we get a reshuffle, because that stock won't be there anymore.
Thoma Bravo, right, the US private equity firm, agreeing to take over Dark Trace.
It seems slightly weird that you're promoted into the FTSE 100 because you've got a big premium being attached to your stock because you're being taken over, and then you're going to leave. So that sounds a little curious to me. Anyway, nice to see you. Thanks for dropping by to see us. Joining us in the Markets Today blog. I want to leave you, we'll be back in a moment, I want to leave you though with the shots coming out of Normandy. This is the American cemetery in Normandy. It sits just, of course, behind Omaha Beach, where 80 years ago today we were seeing huge amounts of fighting. The Americans were fighting their way ashore right now. A little later on, we are going to be seeing the president arriving. I think he's going to be arriving on Marine One. We'll see him touch down a little bit later on. But you're looking at live pictures coming from just behind the Normandy beaches, where 80 years ago today we saw some of the fiercest action of the Second World War, and obviously a huge day for Europe. We'll bring you live pictures as we continue to mark that coverage today. This is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
lot of adjustments in the market. I think to your question, that the first phase of that was, really banks backing off, being more, I would say, more judicious with their balance sheets in a way that took committed credit financing out of the market, which made it hard to transact. Private lenders, certainly to some extent stepped into that breach and were available, but quite expensive. And I think that caused a lot of challenges with buyers and sellers meeting in the transaction market. I think we are moving through that transition. Private credit markets continue to function, but the bank lenders are coming back as well.
Chris Gordon, co-head of Global Private Equity at Bain Capital, giving his view on the shifting relationship between lenders and investors over the last few years. Kriti Gupta is on location for us, of course, at Super Return today in Berlin. It is the world's biggest private equity event, and we cross back over to Kriti with another guest. Kriti.
Yeah, Tom, thank you. And that piece you just heard from Chris Gordon, he's talking about lenders coming back to the market, that mismatch that you're seeing, and really how those higher interest rates are perhaps pressuring the dynamic between private credit and private equity in terms of getting these deals across the finish line. We've got a great new voice. Chris Gordon, they're giving the private equity voice. We've got a private credit voice as well. Cecile Meyer-Levy, head of private debt at TKO, joins me right here in Berlin. A pleasure to have you on the program, Cecile. Thank you so much for joining us. We were just talking about that kind of mismatch. We heard it from the private equity view. We're talking about lenders coming back to the market. Where's the hesitation? Do you see that ramping up?
Yeah, well, thanks for having me. I'm very pleased to be with you today. I will say that this private debt concept emerged on the background precisely of credit violence back at the time of the GFC, and today, so that's really highlighting the key merits of this asset class, where we see the dialogue with the private equity and the private lenders being more and more intense. On the background of the high interest rate, of course, there are some tension that you can feel, and there were some, in a way, also view that because of the global market, the liquid market, the high-end market being shut down since mid-22, the private credit was really the go-to market, and therefore there have been more and more solutions solved thanks to private credit. But now we are also at this stage where we do see the legacy with portfolio impacted by high interest rate and therefore coming to some pressure, and where you need to work out, and you can in a way feel some maybe violence, or I would say more active dialogue, where you need to find solutions. But at the same time, the current environment makes it easier because all those negative factors are integrated in the underwriting, so we hope and we are very convinced that the current cycle will be excellent because you have integrated again this high interest rate, and the leverage has been going down, and the private equity are now aware that it's fine not to have very high leverage type of deal. So that's the good news for us, that it's a more balanced and better landscape.
So tensions, violence, a little active dialogue. Who doesn't love a little drama? I certainly do. When you add in the fact that the leverage loan market in Europe is actually opening up a bit, what does that do to spread compression?
Well, yeah, it's an interesting question. I would say that the very fact that you are asking this question at a private equity, private credit conference is really highlighting the fact that those markets has more and more intertwined now, because we will never speak about a spread compression for private credit, which was a very, by its name, privately held. And now we do see the frontiers becoming blurrier, and no more difference between this pendulum effect going from the public liquid market to the private market, and just for one of the very basic reasons being that the private credit has grown so dramatically over the past 5 years, from a 500 billion overall size back in 5 years ago to currently we say 1.7 trillion, and so meaning that it has become one of the solutions, and you see this public market going up and down, and the spread compression is really reflecting this kind of interconnectedness between the markets. We will, in the past, have never seen this contamination, and now you see, because of public market reopening, the CLO market being much more active. Therefore, there is some competitive pressure going down on the private credit as well, and that's very reactive. And also, in a way, contamination from US to Europe, because the US are usually always ahead. But in a way, that's, again, showing that those markets have become much more efficient, growing in scale.
So one of the big concerns here, and I'm hearing this in the conference, across various players, from the banks to the lenders to the equity folks as well, not to mention simply the PR folks that are really kind of pitch some of these guests to us, is that deal flow is picking up, activity is looking great, the pipeline is only getting bigger to fill that void that you were just talking about post-GFC in terms of financing. Except it feels like the problem as well is what that return of distribution actually looks like. No one seems to time that out, and the backlog is only getting bigger and bigger. I've heard that people are waiting for the capital markets to open up. They kind of already are. What does that look like for you? When can we expect those returns to really ramp up?
Yeah, well, I guess the big key takeaway of this conference, I would say, is this notion that performance dispersion is going to at last arise, and that you will see some difference with the private equity firms who have been in detail and really ending properly their equity story and not relying only on the market and the multiple expansion. We will be at this intersection in the market where in a few years, and I'm expecting this in 2 years, to be able to see the differences with the and in terms of performance dispersion.
All right, Cecile Meyer-Levy, we have to leave it there. The head of private debt over at TKO. Tom and Guy, this is a really important conversation. That return that investors are going to get, can they ultimately deploy it in the public markets? That seems to be the question right now, right here in Berlin.
Chris, having fun in Berlin. Some great guests coming out of that Super Return conference. We'll bring you more coverage from that event. Super Return continues throughout the day. Guest highlights, we got Joanna Barr coming from Advent International. We've got KKR's Peter Stavros. Tomo Bravo is going to be joining us. We've got the founder of Tomo Bravo, Orlando Bravo, is going to be joining us. That is a great guest. You're definitely going to want to tune in to hear what he has to say a little bit later on. I want to leave you, though, with a live shot. We're coming out of Frankfurt today. We've got some great coverage lined up of the ECB event that is going to be taking place. We're obviously going to see that interest rate decision coming out. The key story, though, that you want to be watching out for in some ways is not the rate decision, Tom. It's what comes out in terms of the star forecast, and it's that press conference. What tone does Christine Lagarde put on today's decision? And what comes next?
Yeah, as you said, could it be a hawkish cut from the ECB? We listen in to Christine Lagarde, and of course the update for the forecast around inflation and growth as well.
So there's a great live blog that's going to be running throughout that event. You want to make sure that you've got that up on your Bloomberg terminal. We'll obviously have the press conference for you live. We've got some great coverage coming up as that event kicks off. Markets Today live blog as well. If you want to tune into that too, that is going to be worth watching. The T-Live, though, out of Frankfurt. There's Frankfurt. We'll take you back there shortly. This is Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on their phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays.
This is Markets Today. We are 30 minutes into the European trading day. Of course, when it comes to the macro story, central banks, we are waiting for that ECB decision, expected cut, of course. But also in Europe, another moment of history, more significant, arguably, of course, 80 years, the anniversary, of course, of the landings in Normandy. We're getting live pictures right now from the American cemetery in Normandy, of course, around this date, 80 years ago, 156,000 Allied servicemen landed on those beaches in Normandy. There were, of course, significant casualties, around 10,000 casualties on the Allied side, around 6,000 to 9,000 on the German side. There was something like 7,000 vessels involved in these operations. President Biden, we know, will be on the ground any minute to mark this, of course, 80th anniversary, Guy.
Yeah, we're expecting him. We're expecting the imminent arrival of Marine One. He's been in Europe for the last few days, but this is the sort of the culmination of this event. It's really interesting. I was talking to a number of kind of airline and CEOs and CEOs over the last few days. They're all there as well. I was talking to Ed Bastian, the CEO of Delta. They've had this big program to fly veterans over for the anniversary. Obviously, many of these people are getting on in years, and the 80th anniversary. Obviously a huge event for them. He was talking to me about one guy he's one of the youngest guys there. He basically kind of went in underage and went to the beaches, and they're flying him over. But I was talking to the CEO of Boeing. I was talking to the CEO of United. All these guys are talking about this as being a really big event for American businesses. They see this as being kind of one of the pivotal moments of kind of passing of a generation. And one of the last times we'll be able to do that.
And there are, of course, echoes of history in what we're seeing right now in terms of the conflict, Russia's invasion of Ukraine.
About that. I have to, it was interesting talking to Dave Calhoun about this. He was talking about the parallels. The first time he sees those parallels existing.
Putin not invited, of course, to the 80th anniversary, and many would say for very justifiable reasons. But of course, the Red Army had a key role to play, of course, in the ultimate success in terms of the conflict against the Nazis.
And the Russians were very keen on making sure that this was the second front that they pushed for so strongly to make sure that the German forces were pulled in two different directions. Let's pivot to a different story that is taking place in Europe, and that is the ECB today. We're going to be watching that very carefully, trying to understand exactly how the market is going to react to whatever it is we get from Christine Lagarde a little bit later on. Let's get an insight into what is happening with this. We join now Bloomberg's Ven Ram, part of our Markets Live team. Ven, just give us what's the setup into this event? We know that we're going to see probably a rate cut today, but what we don't know is what comes after that.
Absolutely, Guy. I mean, it's going to be a do something but say nothing meeting virtually from the ECB, because they've painted themselves into a corner about a rate cut for 3 months now. So the decision itself is very, very well telegraphed. But the question for investors, as you suggested, is what's going to happen beyond today? Are we going to get one more rate cut in the rest of the year, or are we getting 2 more rate cuts? The markets aren't quite sure. They're pricing in 1.5 rate cuts. But I think that in the event that the Fed doesn't go, I think there is a possibility that we get just one rate cut in the remainder of the year. That will be a key question for the markets. The other key question for the markets is, where is the ECB's terminal rate, and where is the ECB's neutral rate? And I think Lagarde is unlikely to give us any clear-cut answers on those, because she's been asked about it before and she has never given a thinking about the ECB's neutral rate. But research from the ECB shows that the neutral rate has risen by about 30 basis points since the pandemic. And if you look at the Taylor rule rate, Guy, it suggests that the ECB rate ought to go down to 2.2% given their macroeconomic projections. But if you look at the market pricing for October 2025, they're pricing in only 2.75. So there is a fair bit of skepticism between where the Taylor rule posits the rate should be and where the market is. And that gap needs to close at some point.
Yeah, at some point. The Taylor rule is a guide, I would argue, maybe as other markets, maybe as well. But it's the speed at which that happens, then, that is going to be critical. And it's that rate of change which I think is going to be fascinating to watch, because that could potentially have a meaningful impact in terms of the outlook for the euro. How much volatility do you think we're going to see around today? And how much volatility we're going to see going forward? Because this has been a low vol environment for quite some time.
Absolutely, and if you look at the realized vol on the euro, we haven't done very much at all this year. In the entire 2024, we haven't done much of a range. So I think that will continue. I mean, we may see a 0.2 to 0.3% move in the aftermath of the decision and comments, but that is likely to wither as the days go by. What is crucial for the euro is going to be the dollar side of the equation. And if you look at all the moves in the euro so far, it's been pretty much dominated and come from the dollar side of the equation rather than the euro side of the equation. And that is bound to continue. Why do I say that? Because if you look at inflation-adjusted rates, which is key for the markets, they've moved a whole lot in the US and not so much in the Eurozone. And that is going to continue to be the case. We saw the volatility associated with the ISM services numbers yesterday. And clearly, I mean, the economy in the US is moving in the direction that the Fed wants it to move. But they're not clearly at that stage where they are going to say, you know what, we are convinced that inflation is going to converge to 2%, let's cut rates. They are not going to cut rates. So the dollar is going to be in a position where it is supported, well supported, and the euro is just going to tread water from here in the couple of months, in the couple of months at least.
Okay, euro dollar currently at 108, just up 0.1%. Ven Ram from Bloomberg's MLive team, of course, with the analysis as we lead up to that ECB decision. Ven, thank you. Talking of which, we are live, of course, from the ECB in Frankfurt ahead of that rate decision later today. Lizzie Burden on the ground for us. We're going to get another preview for you next. This is Bloomberg.
Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now.
What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Thursday, the 6th of June. Good morning. This is how European markets look as we open trade this Thursday. As you can see, a fairly positive picture that it continues. And we continue to see strength in some of the core stocks. You're looking at a solid day today for LVMH and for ASML and Novo Nordisk, which has reopened after the holiday yesterday. These are the stocks that are driving Europe today. Let's talk about what the agenda looks like for the rest of the session. 1:15, obviously, we get that. This is UK time. We get that ECB rate decision. We'll obviously break that for you. We get the press conference afterwards. We're bringing that live, definitely here on Bloomberg TV. Claims data out of the United States. Keep an eye on that. That's a pivotal piece of data. It's a weekly data, but we come into the payrolls number tomorrow. And it is, of course, the D-Day 80th anniversary. Those events are already underway in Normandy. We are awaiting the arrival of President Biden in Normandy. Marine One should be touching down very shortly. He has left Paris. EU parliamentary elections begin. The bulk of that takes place this weekend. And Kriti Gupta is enjoying herself in Berlin today. She is at the Super Return Conference, which, of course, is the largest private equity event of the calendar here in Europe. And we're going to be watching that one a little bit later on. Some great guests coming out of that. And we'll continue to bring those guests throughout the morning. The main event, though, from a markets point of view today, though, is the ECB expected to start lowering rates. The first time we've seen a depot rate cut since 2019. Is inflation really moving in the right direction? Critically, is inflation moving in the direction fast enough? Let's try and get an answer to that question. Lizzie Burden is in Frankfurt. She's inside the ECB to set things up for us. Lizzie, what are you expecting?
Yes, Guy, they have let me in. And as you say, it's a historic day with D-Day in mind. It's also historic for monetary policy. It's the first time in history we expect that the ECB will cut interest rates before the Federal Reserve. But this cut today has been well telegraphed. It's fully priced into markets, and it's almost unanimously expected by economists. So the focus, Guy, not so much on what happens today as what they say about the rate path ahead. And doubt has been cast over that recently because of the latest economic data. You've got inflation sticky, wage growth rapid, and particular concern from officials that represent Northern Europe about the need for caution going forward. So in terms of the clues, of course, we'll listen to Madame Lagarde at the press conference, whether she tells us that cuts might be quarterly or whether she sets a cadence of a pause after June and a return to data dependence. and then we'll look at the forecasts. Do we see inflation hitting target in 2025? That's what's expected. But then in 2026, do we see an upward revision? That would suggest that there's a higher bar for cuts going forward. Interesting also from an equity perspective to look at growth. Do we see an upward revision be good for cyclical stocks?
How is the debate, you touched on this, Lizzie, how is the debate evolving, do you think, amongst those ECB governing members when it comes to the inflation story in Europe and whether or not they really have broken the back of it? If we think, for example, about the uptick that we've seen in the US and the cause of concern that has led, for some Fed officials at least.
It's that traditional north-south divide, Tom, where the caution is being called for from those who represent the north versus those in the south of Europe. You've had the likes of the hawks on the governing council, like Isabel Schnabel, Joachim Nagel, kind of ruling out a July cut, and Robert Holtzman saying actually 2 more cuts in 2024 may suffice. So there is this division in terms of the path ahead. In terms of the divergence between the ECB and the Federal Reserve, it's interesting that the conversation has evolved since the last meeting because of this change in the economic data, the suggestion of a persistence of services inflation, domestically driven inflation because of wage growth. Does this problem persist going forward? It has led many to think that actually there are more parallels between the two sides of the Atlantic, even if they had very, very different origins, these inflation crises. In the US, of course, it was massive fiscal stimulus. Here in Europe, it goes back to the energy crisis after Russia's invasion of Ukraine.
Lizzie, looking forward to the coverage throughout the day. I know you'll be walking us through all of the events as we build up to the decision and also then the press conference. I just want to point out to our audience that President Biden just walking off Air Force One with the First Lady, arriving in Normandy. My understanding is that he will now board Marine One and be flown into the event that is taking place at the American Cemetery just behind the beaches in Normandy. But President Biden arriving in Normandy, just stepping off Air Force One with the First Lady, and they will now be making their way towards that event, just boarding Marine One, and we'll continue to keep you up to date with what is happening as events unfold in northern France today on the 6th of June, the 80th anniversary of the D-Day invasion. Let's turn back now to the ECB as we watch the President as the First Lady board the helicopter. Fabio Barbodi, Senior Economist for the Eurozone at HSBC, now sitting next to us. Fabio, we're juggling events here in Europe. The ECB obviously critical to financial markets, and we are going to continue to sort of build up and get excited about this event today. It is the first time since 2019 that we've seen the deposit rate potentially being cut. How critical is this? How big an impact is this going to have on European growth?
Well, I don't think the cut itself is going to have a huge impact. In fact, this is largely seen as an unwinding of the insurance hike that they did in September. So I think, as your colleague was saying before, it will all about the signaling about possible future cuts. And there's maybe a first level of understanding of the meeting that will be whether they retain the easing bias in the current statement. So where they say that if inflation evolves according to our forecast, we want to reduce the restriction further. And then the second level is whether they change the forecast, of course. And we think they will change it, they will revise up inflation, but we don't think they will change it fundamentally further out, 2025, 2026.
So when does the next cut come?
So in our view, the next cut comes in September. I think the recent inflation data a little bit stronger, but also growth showing a little bit more resilience makes it very difficult for the ECB to move already in July. But we do continue to think that inflation being on a downward trajectory should allow the ECB to cut rate further. And when you think about the ECB, you have to think about a central bank that has a lot of inertia in the way that kind of the monetary policy decision work. So it takes a while for them to kind of process new information, to change. Often we find that at every meeting they discuss more the next meeting rather than the meeting itself. So we think that, unless inflation surprise significantly to the upside over the summer, we think they should cut at least another time in September. Our forecast actually is that they will cut 3 times this year, December as well. But obviously I think an interesting element will be to what extent today we're going to continue to see that strong consensus, even among the hawks, that conditions are restrictive, because really so far that consensus hasn't been undermined. And it'd be interesting to see whether some of the latest data data starts to unravel a little bit this situation.
Okay, so both the guests on our show today expecting 3 cuts this year. We were speaking to Vanguard, the economist there, earlier this week, projecting and expecting rates for the ECB to be down to 2.25% by the end of next year. As you project out to next year, where do you see rates?
So we actually have the ECB stopping a little bit earlier, 2.5%. Of course, the discussion about terminal rate is a very early stages. There was an interesting initial suggestion by Schnabel board member that maybe R* was higher in the Eurozone, but we've seen quite a bit of pushback on that, including from some of the hawks on this idea. So in our view, the ECB will have to cut rate further. There's also a fiscal problem for many countries that it's difficult to kind of make the debt look sustainable if rates remain so high. So we think that could also play a little bit of a part. And fiscal policy in itself is important because we're not looking for a fiscal expansion next year in the Eurozone, but rather a little bit of tightening. Fiscal rules are coming back. So that should also help the ECB continue to cut rates a little bit more into next year.
The rules come back 2025, bit of fiscal tightening. That's despite what happens over the elections that unfold over the next few days. What does that do to your growth outlook then for the Eurozone?
Well, that's why we retain a growth outlook which is fundamentally a little bit below or just around potential. So we have processed, of course, the latest news. There have been a little bit of an upside surprise in terms of Q1 growth, of course. But when you look at the underlying growth momentum, we still remain fairly cautious. We think that maybe not all of the monetary transmission has already been worked its way through into the economy. We think there's still a little bit that needs to come. And as such, I think, it's unlikely for us that we're going to be significantly surprised to the upside on growth. And that is an important part of our ECB story, because I said before, if suddenly we do see growth surprising significantly to the upside, that could actually start a little bit more of a debate, like in the US, whether R* is higher, and therefore whether the ECB does actually have to cut rates so much.
Can I just talk a little bit about what's happening in more detail with the fiscal story? And maybe actually more detail is the wrong way of putting it. Europe has a lot of spending to do. It's got to navigate the energy transition. We've seen the impact that energy has on our economy over the last few years. On the day when we're looking at what is happening in Normandy, we've got a lot of defense spending that we've got to do as well. Now, we don't know how all of this is going to be funded. We've also got big welfare bills that we've got to feed as well. How do you marry up what is going to happen on the fiscal front over the next few years and the amount of money that is going to have to be spent with what is happening with the monetary side? Because at the moment it feels like over in the States, the Fed is just kind of trying to hold back the fiscal, trying to just keep the economy on an even keel, given the amount of fiscal spending that is happening. Europe's going to go through that, maybe on a slightly sort of slower curve, but it is coming.
Yeah, I mean, I think there's different level to this question. I mean, if you look at the individual countries, particularly some, there's very little fiscal space there. We've seen significant fiscal slippage in France. Indeed, the S&P just revised down the ratings of France. So it's very difficult for France to spend more, similarly for Italy. But at least for some countries, there is still quite a lot of support coming through into the pipeline from Next Generation EU, of course, because so far they've only spent a very small proportion of that money. So that should provide a little bit of stimulus. And then coming to the most important part of your question, could they do a little bit more of joint spending? This is what everyone is thinking about, potentially even after the election, negotiation of the new 7-year EU budget. Could that unlock the potential for more joint spending on defense? So we think progress will be very gradual on that front. It's very difficult to justify more joint spending while you have only spent about a third of the previous Next Generation EU. So we think that will take some time, but it's probably coming. A possible election by Trump in the US could even be a bit of a trigger point for Europe to understand that they need to spend a little bit more. But the important thing when you think about defense spending is, does it actually favor Europe? Because, for instance, all the spending that has been done on Ukrainian defense so far, only actually 20% of that ended up benefiting Eurozone firms. 60% ended up benefiting US firms. So that's also something that EU has to work on, not just spending, but building the capacity to actually create more long-term growth.
Would you have to rewrite your forecasts on EU growth if there is a Trump presidency, given those threats of 10% tariffs?
Well, certainly the tariffs could be quite important. I mean, we always need to kind of see to what extent they will be applied, how they will apply. They will affect some sectors more than others, but it will probably affect some of the kind of the nascent trade recovery that we're seeing. You know, we know that the typical growth cycle in the Eurozone tend to be led by exports and then feeding into wages and investment. So certainly that could be a hiccup on that, as could be, for instance, a possible retaliation by China on some of the tariff that Europe has said yesterday that they would like to impose on EVs. So,
Fabio, I've got to leave it there. It's going to be an interesting day. I'm glad you're excited about it as well. I certainly am. We're watching the event a little bit later on in Frankfurt. Fabio Barboni, senior economist for the Eurozone at HSBC. A reminder, of course, there are multiple ways of getting Bloomberg coverage of this event. We will bring you the policy decision. That's coming at 1:15 UK time. We're also going to bring you President Lagarde's press conference. That's going to be half an hour later. There will be a T-Live, a top live blog that'll be running throughout this entire event as well. So some great coverage, Tom, coming up right here on Bloomberg.
Yeah, and we were talking about the fiscal impulse, or maybe the challenge, or at least the constrained fiscal impulse coming through from the EU, even as it faces up to those challenges around defence, of course, and the green transition. Part of that will be part of the debate that filters through across the elections in the Eurozone, with the Netherlands the first country to kick off 4 days of voting in the European Parliament elections later today. More than 370 million people across 27 EU nations are eligible to vote. Let's bring in Bloomberg's Ollie Crook for the latest then. What is the timeline? Talk us about how this unfolds, Ollie.
Yeah, Tom, so the polls have been open for just about 2.5 hours in the Netherlands. So the first votes have already been cast in the EU election that will really set the course for the EU in the next 5 years. So the Netherlands will vote today. They will elect the 31 of their MEPs of the 720 in total. And then tomorrow we get Ireland, we get a couple on Saturday. But then really the main event is Sunday when you have France, Germany, Spain, and actually most of the EU voting for their delegates. Now, what do you get on Monday? You get an idea of the parties that have been elected to the parliament, the smaller parties. And then what happens from there is you need to figure out which of the sort of broader groups in the parliament these parties will actually go into, right? So some of these will not change, but there's some real question on the right. A, how well the far right is going to do, and B, where will these parties then sit into these individual groups, which then kicks the conversation to the EU leaders, and this is where you have the sort of cloak and dagger, backroom discussions of who they want to put forward to be the Commission president. The odds right now are probably Ursula von der Leyen. Then it goes back to the MEPs for their vote. They need to have a majority, and that is a secret ballot, guys, so anything could really go there. And Ursula von der Leyen only won by sort of 9 votes last time around. So things get kind of interesting there. But if everything goes smoothly, we should have the architecture of this new EU by sort of mid-July.
Ollie, as we watch events unfolding in Normandy, it is a reminder that Europe is facing a significant security threat coming from Russia. To what extent is that affecting what is happening with this voting? How big a factor could it be? We're obviously seeing a significant rise as well for right-wing parties. Again, how does that security narrative play into that?
Yeah, I mean, listen, this is a huge topic for the EU election, and obviously will vary from country to country. You go to the eastern flank, it's obviously the concern number one. I think that there is a real consciousness in Europe that the defense spending needs to get up there. The question is, how do you actually do that? Will there be joint debt? There's huge debate around that, obviously. But I think that also, Guy, when you think sort of more philosophically and you step back at what the EU is, I mean, it was really born by the end of this war. It was born out of that. The first EU election was in 1979, and it's all come to sort of prevent these kinds of wars. And when you think about the EU as a bloc and the challenges that it faces right now and the competition it faces from China and the United States, it really needs to decide how to undertake those challenges. And some of the policy solution from the likes of Macron and Scholz is a more unified Europe. Now, with this election, if you see sort of more Euroscepticism being sort of breathed into the European Parliament, could that slow it down? But it doesn't answer the fundamental question, how does Europe remain competitive?
Ollie Crook, thank you very much indeed. As you were discussing there with Guy, ripples of history as we look at live pictures of the 80th anniversary, of course, of those D-Day landings in Normandy. This is the American cemetery, I believe, in Normandy, of course, just beyond those beaches where 156,000 Allied servicemen landed 80 years ago today. We'll keep across this story for you and, of course, all the market implications of the ECB. Guy Johnson stays with us. Markets Today is wrapped up for today. The Pulse, though, with Guy Johnson is next. This is Bloomberg.
politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
This is Bloomberg.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
And market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Guy Johnson in London. Francine is off today, but let me tell you what's coming up on today's program. The ECB is poised to cut interest rates for the first time in almost 5 years. We're going to take you live to Frankfurt for that event. European stocks rising ahead of that ECB decision. Tech leading the gains. This after we saw fresh record highs on Wall Street last night. ASML is leapfrogging LVMH to become the second most valuable stock here in Europe. Nvidia has now overtaken Apple. Plus, veterans and world leaders commemorate the 80th anniversary of the D-Day landings in Normandy. We are going to continue to bring you live pictures from northern France throughout the program. Before we do all that, let me just take you to the markets and talk a little bit about what is happening right now. Equity markets generally reasonably well bid across Europe. The Danish market has returned, so we're seeing Novo Nordisk rising quite sharply as well today. That's why you're seeing Denmark outperforming today. But the DAX is up by 1% today. Tech stocks are doing relatively well. The CAC is up by 0.3%. The FTSE 100, a little bit of a laggard, only up by 0.1%. But European equity markets continue their move higher alongside what we're seeing in the United States as well. Claims data a little bit later out of the US, building up to the payrolls number, of course, tomorrow. We are watching today the ECB. S&P futures at the moment fairly unched. We'll see if they gain a little bit of momentum. We are seeing the 10-year on offer today, so yields are rising just a touch, but generally the narrative over the last few days has been yields lower. The euro fairly flat. We wait to see exactly what that decision looks like coming out of the ECB. We know what the decision today is, but what are the projections going to be, and when does the next rate cut come? Crude a little higher today, up by 0.9%. We continue to digest, obviously, the decision out of OPEC earlier on this week. I want to take you first to Frankfurt, though, in today's show. That is where the main event from a financial market point of view today is. The ECB is expected to kick off its rate-cutting cycle. Is it going to be a cycle, I think, is maybe a critical question. And we're going to see maybe the ECB going before the Federal Reserve. That hasn't happened. Well, it hasn't happened ever. So despite the bumpy retreat in price growth, in inflation here in Europe, Christine Lagarde declared in May that inflation is under control. But the latest data maybe calls that into question. But she's committed to this June cut. So the critical question is, what comes next? So let's talk about this. Let's go to Frankfurt. Let's go to the ECB. Lizzie Burden joins us from there. She's going to be covering this event for us today. Lizzie, you're inside the building. You're not inside the room. So what is happening inside the room? Set us up right now for this debate that is taking place on the Governing Council.
Well, Christine Lagarde is inside the room, so is Robert Holtzman. We've seen them entering the ECB. She did not want to cut rates before the Federal Reserve guy, but it looks like she's going to today. She's telegraphed it well. It's fully priced into markets, and economists almost unanimously expect this quarter-point cut to 3.75%. But as you say, that's not the focus. The focus is the rate path beyond this June meeting, because we've had this recent economic data muddying the waters, rapid wage growth. We've had inflation sticky and output surprisingly robust. Officials for Northern Europe particularly concerned and wanting some caution here, and therefore traders paring their bets. They are now expecting 2 cuts this year, unlike economists seeing 3. We've also had a bit of warning from some of the Governing Council members, the likes of Joachim Nagel and Isabel Schnabel, kind of ruling out a July cut, and Robert Holtzman saying that he expects only 2 cuts for the rest of 2024. So, as you say, very important to focus on those forecasts, in terms of clues for the path ahead. Yeah. Look particularly at whether there's an upward revision for inflation in 2026. That would be potentially a sign that there's going to be a high bar for cuts coming forward.
Lizzie, there was this view that the ECB and the Fed were now on very different paths. The Fed was dealing with inflation and was unlikely maybe to deliver many cuts this year. The ECB felt like it maybe had an easier decision in some ways because inflation was coming down as the energy crisis abated. The picture's starting to look a little bit more nuanced.
It really is, and think back to the start of the year, the end of last year, the pivot party that Jay Powell kicked off. We did not think we would be in this position where actually it was Christine Lagarde buying drinks for everyone at the bar, as we were putting it back then. But yes, the picture so different now. The origins of the crises were different. You had in the US the fiscal stimulus, and in Europe the energy crisis after Russia's invasion of Ukraine. But at this point, parallels drawn because of the difficulties of taming inflation right down to target, as shown in that economic data recently that I mentioned. And so it could be that actually, Guy, we don't see as much divergence as even we thought last meeting between the ECB and the Federal Reserve, which of course is crucial for the market impact. Perhaps we don't see as much euro-dollar weakness. That very much will depend on Christine Lagarde's clarity about the path ahead in the press conference half an hour after the decision later.
We'll bring you that press conference live a little bit later. Lizzie, thank you very much indeed. You're going to be driving our coverage throughout the morning as we build up to that event. Lizzie Burden in Frankfurt for us. Remember, we get the decision 1:15. We get, as Lizzie was saying, the press conference 30 minutes after that with the President Christine Lagarde. That is going to be a must-watch event today. And, of course, there's going to be the markets live coverage plus the top live coverage that you'll be able to access on your Bloomberg terminal. Let's talk about that coverage and what we're going to be maybe hearing within it. Noor Al-Ali joins us now from the Bloomberg Markets team to walk us through what she's anticipating, what the team's anticipating. I'm quite excited about this, not because we're going to get a rate decision today, and it's the first time we've seen a rate decision, the depot rate being cut, but because I'm really curious to see how Christine Lagarde plays it. She's got a really difficult conundrum now in front of her, and I'm just wondering how she's going to navigate it.
Guy, I'm equally as excited. I know that, if you look at implied volatility for the euro, it's looking like a snooze fest today for the FX market.
It's picked up a little bit.
It has picked up a little bit, and I'm really excited about that. I think it should pick up a lot more because this is the day, right? We are expecting the European Central Bank to cut interest rates before the Fed for the first time ever. This is a historical moment. Now, I know that down the line there's a lot of uncertainty or unclarity, but the projections from the ECB are going to be quite interesting. What they do as well with the balance sheet and the PEP reinvestments is also very interesting. And reminder, we have jobs data tomorrow, CPI US next week, and FOMC meetings. So this is an incredibly exciting week that's setting up the tone for the markets into the summer.
But the macro is a little uncertain right now, and we're watching the data really carefully. Got claims coming up a little bit later, as you say, we get into payrolls and then into CPI over in the United States. But the equity markets just keep powering higher. And there was this kind of narrative at the beginning of this year that equity markets could power higher because rates were being cut. And we saw the December pivot, and then equity markets took off. And it seemed to be on this narrative that as rates came down, that would be positive for equities. That's completely flipped on its head. I'm struggling to understand the relationship between kind of rate expectations and the equity market at the moment, because it's been a random walk this year.
Yeah, absolutely. But look, maybe it's not so random, right? Because we've been talking about how there's this momentum in stocks that we've not seen in quite some time. And it's really almost, I would say, crazy to go against that, right? Stocks have been rising. NVIDIA now topping Apple's market share. We're, approaching those record levels again. The S&P 500 hitting fresh records time and time again this year. And if you look at both ends of the spectrum, so if the Fed doesn't cut rates because the economy is doing so well and it's going in that full momentum, then stocks are going to do very well, right? Because that's earnings yields doing well.
But the bond market is beginning to sniff out something a little bit different. The bond market is telling me a different story. If I listen to the sounds coming out of the bond market, it doesn't sound quite the positive narrative you just laid out.
Absolutely. And if you look at the 60-40 portfolio, you'll see that stocks and bonds had been kind of moving in the same direction for quite some time, which doesn't offer that diversification that investors were seeking. So potentially now, oddly so, stocks are looking to give in that diversification. But let's say the Fed does cut rates, then what happens to stocks then? They rise again. So I think...
But why are they cutting rates, I guess, is that we don't... That'll be the question. If this is a kind of mid-cycle slowdown narrative, that kind of makes sense. But if this is a recession coming, that's a different story.
That's very concerning, right? And we had Simon White recently point to the fact that, we could get another meltdown in another, bank or another company, similar to the one that we've seen in SVB last year. And if that happens, all bets are off.
All bets are off. Nora Ali joining us from our Markets Live team. Thank you very much indeed. We're going to have some great coverage coming up throughout the show, throughout today's coverage of the ECB. We're also, let's not forget this, we've also got the day 2 of the Super Return Conference that is taking place in Berlin. We're going to be speaking exclusively, we're going to be hearing exclusively from Joanna Barr, Global Head of Limited Partner Services at Advent International. That's coming from Super Return a little bit later on in the program. Really looking forward to that conversation. This is Bloomberg.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. We do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything.
Welcome back. It is, of course, the 6th of June, the 80th anniversary of D-Day. The President of the United States, Marine One, just touching down in northern France as he makes his way to the American cemetery just behind the beaches where 80 years ago today we saw some of the fiercest fighting of the Second World War. The President arriving with the First Lady to commemorate that event. You can just see the delegation leaving Marine One. We'll continue to monitor events, bring you all the live pictures from the events that are taking place in northern France. So we'll see very shortly, maybe not from that helicopter, maybe from another helicopter, the President arriving. Maybe his helicopter is just beginning to touch down now. Anyway, we'll continue to bring you those pictures. I can see under the corner of my eye, the President is now just touching down. Air Force Marine One just landing now. The second helicopter in on the pad. We will continue to bring you those pictures, as I say, as the President arrives in northern France. I want to take you to Berlin now, where we see the Super Return Conference taking place, day 2 of that event. Danny Berger's had some great guests, and that continues this morning. Danny, over to you.
Thanks, Guy. Regret to inform you, no helicopters here, but plenty of heavy hitters. I'm really pleased to say that joining me this morning is Johanna Barr, Managing Director and Global Head of Limited Partner Services at Advent International, a giant in its own right in private equity. Johanna, thank you so much for joining this morning.
Thank you, Danny, for having me.
So you spent essentially the last 24 hours, let's call it a speed dating process, where you've met with investors, LP, nonstop. What's the mood you've gotten?
I think the mood, maybe somewhat surprisingly, is actually a lot lighter than it was 12 months ago. So investors, I think, are feeling a little bit better about life. They're seeing some distributions coming back. We've had a number of LPs who are a bit more active on the smaller end of the market, saying that their year-to-date distributions are already matching what they had last year. And so I think that's all good news for the industry. And
we'll talk about the distributions in a moment, because I know that's been a sticking point for this industry. They're happier, but are there any still of those risks lingering, especially because we're still living in a higher rate environment? That threat hasn't gone away.
That's true, and I think it's down to the private equity firms like ourselves and how we navigate that environment, especially with our existing portfolio and some of the older portfolio companies we have in that portfolio. But I think on that side too, the credit markets have become much more favorable, and what you're seeing is the ability of managers to reprice some of the debt in our portfolio companies and also significantly reduce the burden of the interest rate expense of our portfolio companies.
So the debt burden's lessening, returns are coming back. There was this great Bloomberg story that we had. It was at a big investor meeting for a private equity fund, and someone was wearing a t-shirt that said DPI is the new IRR, which of course is just a way of saying that getting your money back to investors is more important than returns. Are you also getting that sense that at this moment people are saying, look, we can forego a little bit of the juice from returns in order to get cash back?
I think investors still want to see absolute good returns. So I think you can't reduce your return threshold, but I think they want to see the money sooner rather than later. And so ultimately, there has been a bit of delay in the exit pipeline partly as a result of COVID and then the inflationary environment that followed. But I think investors are really pressing now and saying, okay, you've got a mature portfolio in some cases, how are you going to move that to exit?
And the exits mostly, though, have happened with quality companies. That's what we've seen trading. Yeah. What finally gets those lower quality companies to have firms exit, to see them sell it? Because that's kind of what we're waiting on at this moment.
I think even with those companies that are maybe not sort of the crown jewels in GP's portfolios, I think the interest rate environment settling now, we're all expecting a rate cut today from the ECB. I think that gives investors clarity around how to manage the future of their portfolio and to price certain things in. And so ultimately the price finding mechanism will prevail here, and I think even those assets will start to trade. The other point I'd make on the exit, though, what we found is that where you do have a portfolio which you can sell to trade buyers, I think that's been very strong in terms of exits. So also from an Advent perspective, if I look at what's worked in 2023, we had a very strong exit year with above $8 billion of realizations, but the majority of those exits came from sales to trade.
How many questions are you getting about AI in your AI strategies and portfolio companies?
Not as many, actually, as this time last year. So this time last year, everybody wants to understand AI and what it really means and what the threat to the portfolio would be. I think this time around, they're more interested to your question around what are the portfolio companies doing with AI? How are they benefiting from that? And
do you think it's hype that's died down? Is that what you're saying?
It's not hype that's died down. I think people are sort of realizing it's not going to happen overnight. But I think where the answers that we are giving is where a portfolio company has a real, let's say, treasure chest of data that's really unique to them, and if they can now apply AI tools to that, that's where the real value comes from.
Johanna, also when we did this last year and we spoke, it was a period for private equity, private capital, where fundraising was challenged. It was much about what we were talking about, this idea that exits were happening, so LPs didn't want to allocate more cash. Mm-hmm. What does it look like now? Has that fundraising iciness for the industry started to thaw?
I think that's certainly what everybody's hoping at this conference this week. I do think fundraising will get a little bit better from here on in. It was an extremely challenging, I think, already second half of 2022, extremely challenging 23. But I think as we go into 24 and 25 in particular, we are hearing from investors that budgets are improving because of some of those distributions have come back. Also, public markets have recovered nicely, so some of the denominator issues have improved, and so the whole equation is improving. On top of that, you do have a number of programs who continue to see real value in the asset class and are increasing their absolute allocation to alternatives, and that's also helping the industry.
So Scott Kleiman yesterday, speaking to our Jan Henrik on a panel, basically said, I'm here to say that not everything is okay, that we had an over-deployment in the early days after COVID. People bought too much at too high valuations. Would you agree with that maybe not everything is okay?
Yeah, I mean, look, you have to look into your own portfolios and be critical of kind of some of the, what are the investment decisions that were made, what are the prices those were made at, and realize that for some portfolio companies, you have to grow into some of the multiples that were paid at the peak of the market. But as long as you've gone in with a real value creation plan around what you were going to do, and you continue to execute on that operationally, I'd argue, on the whole, these portfolios will do very well.
So you have to do the hard work again.
You have to do the hard work. But look, this is what private equity should be about. If you go back all the way to 2007, we used to have a high interest rate environment. We used to have high prices. And if you look at those vintages, even the GFC vintages have done actually pretty well in the end. And so I think we need to believe in our own operational capabilities to see through these portfolio companies.
It's funny how we sometimes have a short memory that way. Johanna, thank you so much for joining this morning. Really appreciate your time. Enjoy the rest of the conference. Guy, that was Johanna Barr of Advent International.
Great conversation, Danny. So many great conversations coming out of that event. Thank you very much indeed. We're not done with Super Return, though. Peter Stavros, co-head of private equity at KKR, is going to be joining us. And we've got this, an exclusive conversation with Orlando Bravo, co-founder, of course, of Thoma Bravo. Those conversations coming up throughout the day. Some great conversations already out of Super Return, many more still to come. What are we going to do next? I want to take you back to the elections that are taking place in the EU over the next few days. We're going to take you to Berlin again for the latest on that story. This is Bloomberg.
CFOs are reshaping the C-suite, Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key.
You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It is June the 6th, 80 years ago today, D-Day was underway. You're looking at live pictures coming from the American cemetery just behind Omaha Beach. The President of the United States has just arrived. This on the day when we start to see votes being cast across Europe in the EU elections. I want to draw a line between these two events. Ollie Crook now joins us now from Berlin. Ollie, draw that line for me. Europe is facing a significant security threat. This is 80 years ago. We saw the D-Day invasion. Draw a line between these two events.
Yeah, so Guy, I mean, obviously defense is going to be top of the agenda for this EU election, how basically the Europeans will build out their defense apparatus. And that is going to be one of the sort of main things that Europe needs to figure out going forward. Will there be joint debt? Will they support Ukraine to the same degree? There's some debate about that. But Guy, if we also think, just step back philosophically, the EU was born out of this conflict. And the real question is that, so 20th century EU is all about keeping peace and harmony, economic prosperity. What is the 21st century EU? And this is the question of a bloc of countries, one of the richest in the nation, that need to go up against the United States and China and remain relevant economically and continue to pursue their objectives. And that is what the EU Parliament will define for the next 5 years.
Ollie, thank you very much indeed. Rishi Sunak, the British Prime Minister, the current British Prime Minister, is in Normandy. We're going to talk about the UK election next. John Caldwell, a donor to the Conservative Party in the past, is he thinking of switching sides? We'll find out next. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
DOJ or other authorities.
Could face bigger challenges next.
Was going to keep Green World Cup. This is a three.
As the economic picture
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Morning, welcome. You're watching Bloomberg UK. I'm Guy Johnson in London. Let's talk a little bit about what comes next. We are approaching the general election. Obviously, funding is a key part of that story. And we are certainly seeing maybe a few of the big funders of the Conservative Party in the past maybe thinking about taking a different direction. One of those potentially is the British billionaire and founder of Phones for You, John Caldwell, one of the Conservative Party's biggest individual donors over the last few years. Recently, though, a little bit more critical of the government, and in particular, the record it has delivered on boosting investment. A report this week that he commissioned actually says that Britain is one of the only major economies without a proper industrial strategy and continues to suffer from a chronic and short-term approach to funding of innovation. He's been lobbying and has been certainly upping his efforts and calls for the government to create an environmental tech-led enterprise zone in the UK. John Caldwell joins us now. John, welcome to Bloomberg. Thanks for the time this morning. Look, the story over the last couple of days is that you would be willing maybe to switch allegiances, that if we see a big majority maybe for the Labour Party at the upcoming general election, and if the Labour Party delivers a bold industrial policy going forward, you would back that. So let's maybe get into that a little bit further. What does a bold industrial policy look like, and what do you want to see Labour delivering were it to win the election?
Well, I think, first of all, there's a lot of synergies between a very successful business and a successful country. And we need to be run more in a commercial way rather than a political way. Commercial means how do we grow the economy of the UK? How do we put the great back in Britain? How do we become attractive to inward investors? And there's many methodologies for that, but we need high technology inward investors to bring technology to Britain, to grow high-paid jobs, to grow exports, both in product and intellectual property all over the world. And the best way of doing this, in my opinion, is the environment, because the environment is under such colossal threat. And even those people that may not believe an apocalypse is coming down the road, they may not believe it now. I can assure you over the next few years, as more and more local devastating events occur, people are going to realize that a global apocalypse is coming down the road. And therefore, investment in the environment in general, in climate change, is a monstrous investment that will be exportable all over the world. And I want Britain to be at the forefront of that.
So what does that mean? Does that mean an active industrial policy? Is that what you would like to see here, akin to what we've seen maybe in the United States with the Inflation Reduction Act?
Well, we've just done a study called Caldwell Strong Britain, which highlight 10 points of improvement. And that ranges from science and technology strategies right the way through to improving universities, to growing our talent pool of people. But the number one thing that we can do above and beyond everything else is set forward a specialized tax regime for inward investment in high-tech companies. We need to be the Silicon Valley for the environment. Now, whether that's a local area that we set up or whether it's just a virtual network doesn't really matter. It would be great if it was everybody all in one designated zone, but the zone could just be virtual. And what I would do if I were running the country, I would have a group of businessmen who were interviewing potential applicants for this special enterprise zone. They'd want to be part of it because they were to have very, very attractive tax breaks, and there'd be other investment opportunities as well, both from government and from a third-party fund. So everything would be put into place to attract inward investment and help that inward investment grow, prosper, and produce cutting-edge technologies in the scientific and technological space, but really specialized on the environment, because that is where the desperate need is really going to come from.
Why? I appreciate what you say about what is happening with the climate, but do you think that would be the best use of resources, or do you think a focus maybe on technology like AI? The UK has significant leadership, you could argue, in the latter. Does it have sufficient critical mass in the former to justify the investment you're talking about?
Well, first of all, of course, within my technological advancements, I am talking about AI. I'm talking about anything that is high-tech, highly scientific, that produces great results. And AI, of course, as we all know, is phenomenally exciting for the future. Only this morning I joined a new AI platform, and I put into it, and it creates videos, and I put into that platform how to make Britain great through tax breaks and through making Britain a very attractive inward investment environment. It produced the most amazing video. I mean, it wouldn't be the finished product. I would have to tailor it a little bit, but I was actually immensely impressed. And this is the speed that AI is coming to us at, and it's almost frighteningly fast. So, of course, my technological inward investment ideas, of course, they include AI, growing all technological aspects, but the environment is the big one, because if we don't do that, we're going to be in such a horrendous mess going forward. And this is Britain's opportunity to be right at the forefront of that. I was very disappointed when Rishi went backwards by making 2030, 2035. That was a really negative step, because at least in showing Europe and the rest of the world the pathway to net zero, we advanced by 5 years on most of the rest of the world, and then changed their mind. And that really was, for me, catastrophically wrong.
If the Labour Party were to deliver something akin to what you've just described, would that be something that you would be prepared to back? I.e., would you, and I'm talking here about backing the Labour Party, there's been obviously significant interest over the last few days in potentially you making that switch. If we see a big majority for Labour, Labour does what you're describing, we get the political stability that many in business certainly crave at the moment, would that be something that you would be prepared to get behind in terms of your funding of political parties? I.e., would you be prepared to back the Labour Party if it delivered that?
Well, I've always made it very, very clear that I would back any party that I believe does the right things commercially for Britain to grow Britain's GDP per capita, and to therefore be able to use all that extra tax revenue to make people's lives better, especially those that are really at the moment deprived at the bottom end of the scale. So I've always made that really clear. I have been a lifelong Tory supporter, because the policies of the Tory party have always been the ones that I believed in, that would make Britain the strongest it could be. That said, over the last few years, I've been very disappointed in the Tory party performance. I don't see anything that is helping us to put the great back into Britain. When we look at the GDP per capita from pre-2008, we're no further advanced now. And it's not all about just producing commercial growth, but if you don't produce commercial growth, you can't look after the poorer people's society. You can't invest in the health service, in the schools, and in those people that desperately need social services for whatever reason. And as a humanitarian, I desperately want those people to be invested in, but I want to do it through capitalism and low tax to drive Britain forward and make it extremely attractive to inward investors. So in answer to your question, that was a long answer, I will support whoever puts in the right commercial policies to be great. I'm not interested in politics per se, which is the tweaking and messing about with certain things. Like, for instance, I'm not a fan of what Labour are talking about now, putting VAT on private schools. I don't think it makes commercial sense. I think it'll starve people out of the private sector of school, put them into state schools. I don't believe it'll be a net revenue generator. It'll do damage to private schools, and it'll make some parents' lives very difficult. That is not a policy that's good for Britain, in my belief.
Okay.
But if Labour policies in...
John, just very briefly, because I'm slightly running out of time. Can I just ask you a quick question on one policy that I hear continuously from British business leaders? They would like to see the UK rejoining the customs union, and we've already seen the impact. You talk about what is happening with net zero, the impact potentially on the car sector as a result of being able to access batteries and a wider market. Do you think it would make sense, given what we see, given the challenges and the scale required to deliver, particularly on the climate, do you think it would make sense for the UK now to reconsider its membership of the customs union?
Well, I think first of all, we've had a real struggle post-Brexit to make everything work. And I don't think we've seen the full benefits of Brexit yet. What we've seen is the negatives. What I'm talking about here is operating outside of the EU in a way that really competes dramatically with the EU to bring inward investment. I don't think being part of that club is necessary. But let me give another example of some of the negativity I have about the EU. When we look at the aid for Ukraine held up by Hungary, a Putin supporter, I think that's disgraceful that that club of the EU can be held up from doing what is clearly right in the vast majority of the EU opinion, can be held up, and those poor Ukrainian people have been fighting with lack of ammunition because of Hungary. And that is just completely unacceptable in an EU constitution. So for me to want to be part of that EU, the constitution would have to be changed dramatically.
John, thank you very much indeed. I understand you're going to be getting on your bicycle now. We wish you good luck with that ride. Thank you very much indeed for taking the time to join us. The UK entrepreneur and founder of Phones for You. That, of course, was John Caldwell. Coming up next, we are going to be hearing from a former BP CEO, Lord John Brown. We're going to be hearing about how he views the upcoming election. That's next. This is Bloomberg.
The top names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. From the world of politics to the world of business, Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
So, the former BP CEO, John Brown, one of the first CEOs of a major oil company to link greenhouse gas emissions to global warming. He caught up with Francine to talk about the future of climate investment in the UK and how it factors, he thinks, into the upcoming general election. Take a listen.
I think climate should have a vote, a big vote. And one of the tests that I would apply to any party contesting the general election is, what are they going to do about climate? What are they going to do? Clearly, you could look at the UK and say, what an irrelevant country. 1% or less of global emissions, so does that matter? The answer is yes, it does, because the innovation in this country, which has been long-standing, needs to be revived and produce the technologies and the processes to get climate change under control. And we should be doing it here. We should absolutely be doing it here, and we can. So I'd be testing that, see how we can do that, how we can readjust investment to get that done. And I think there are ways of just doing that.
So how would you do it? Because there were pledges, 28 billion, they were retracted. It's the hardest fiscal kind of conundrum that the UK has gone through in 70 years. So do you need to find the money?
Yes, you do. There are three things you've got to do. One, I think you've got to, first you've got to worry about how much is public money and how much is private money. Public money, including tax release, that's also public money, needs to come from first focusing what we're doing. I think we're trying to do too many things across the board. Well-meaning, yep, but don't move the needle. So I expect there's some money to come out of that. Secondly, there's clearly money to come out of asking ourselves, what are we doing in the oil and gas sector? Should we be carrying on as we're carrying on? And the answer is probably not. And we could save some tax rate long-term in that. And thirdly, we have to worry about what are the things that we've dedicated money to that probably don't need to be done just yet. And one of which, for example, is the huge amount of money which could be spent in the abandonment of oil and gas facilities. We could defer, change that. So I'm all in favor of finding ways to get the money, but more importantly, to dedicate that money to the development of non-hydrocarbon sources of energy.
What do you think the election will be fought on? The economy?
Without any doubt. In the end, all elections have a lot of what's in my purse or my wallet as part of the features. I think there are so many things being sprayed around at the moment that I'm sort of stepping back and saying, in the end, I think people will want competence. They'll want change. I mean, inevitably, people look for change. And I think they want to have a sense that the country has a strong future. In other words, it could grow properly. For my book, a lot of that's got to be in science and technology, and a lot of that has to be in climate.
Does the UK need its own Inflation Reduction Act?
Well, it could, but the thing about the Inflation Reduction Act is you have to be a very wealthy country to be able to put such a piece of legislation in place. It is open-ended. There's a lot of money involved here. which the US can afford to do, and the UK probably can't. It's a big gamble on putting a lot of state money behind something that could get private money and grow. We can do some of that. And the UK has been very successful in things like incentives for wind, the so-called contracts for difference. Very clever idea of, making sure there's a floor and, making sure there is a ceiling which, people don't get too much of a windfall. So this is not a bad way of doing things. So the UK needs to revive its creativity, and it does have creativity, to go forward in this area.
There's also talk of Total of France, but also Shell here in the UK, listed in the UK, of looking to possibly list in New York because the capital markets is more friendly to oil companies.
I think, people have been at this for a long time. Even I was, thinking, the multiples are different. But in the end, there are so many things you've got to get right to move, including getting a very large supermajority of your shareholders to approve it, that you don't. I think that equity markets are becoming more and more global. So there's less of a reliance on local markets. Local markets are much more for debt and for derivatives, things like this. And I think the equity markets become much more global, helped not least by people like Bloomberg.
So did you at the time actually look at possibly delisting and listing in New York?
Oh, yes,
or was fanciful?
No, we were looking at all these things, because the majority of the company, when I was CEO, was in America. And actually, we realized that after a few years that about 5% of the company was in the UK, and we were listed in the United Kingdom. Now, we had a very good American Depository Receipts program in the US, and a lot of good US shareholders. And you have to really work with the US to get these shareholders. Performance matters.
But so what you're saying is that it doesn't really make sense. So Shell shouldn't stay here because it's attached to the UK. It makes little business sense to move.
It makes, people are quoted by historical accident in some ways. The BP was quoted here because, of course, it was a state company for many years. Shell was quoted here and in Amsterdam, and then concluded that here would be the right place to quote. But these things will sort themselves out, provided your shareholders agree with you. If they're ready to get you to move listing, they'll vote for you. If they won't, they'll stop it.
Lord Brand, talking to Francine, of course, the former BP CEO, chairman now of Beyond Net Zero. That's a climate venture from General Atlantic. What are we going to do next? We want to talk about what the tax change could look like under a Labour government and how people maybe are going to start rejigging their finances, already are rejigging their finances as a result of that. What's a safe asset going into a Labour government? We're going to discuss that next with John Stepek. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars. Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Britain's rich racing to protect their wealth ahead of the election, ahead of an election hit. That's the story on the Bloomberg terminal this morning. Are they right to be worried? Let's find out. John Stepek standing next to me. John, what do you think?
Yes, I think that it's reasonable to be worried, and if you have the means to organise your affairs in such a way that you can leave the UK or protect your wealth, then it probably does.
Okay, that's two different things. Okay,
yes.
So staying in the UK and protecting your wealth, what are people worried about in terms of how Labour policy could impact wealth if you stay?
Well, I suppose neither party's been terribly honest about the fact that we're going to have to put taxes up. Yeah, exactly. Nobody's going to want to do that ahead of an election. But the fact is, the national balance sheet is not in great condition. Both parties have made quite a big meal of the state of the national balance sheet because of what happened with Liz Truss.
Yeah.
So even though we actually probably do have more breathing room than they would like to acknowledge, they're not admitting that. And so that means the taxes are going to have to go up. And the problem is they keep ruling out all the big taxes. And so everyone's sort of racking their brains thinking, well, where might this come from? And for example, for your personal finances, the pension is an obvious one.
Inheritance tax.
Inheritance tax is another obvious one. There's even been talk about possibly looking at the taxation of ISAs. ISAs is another big kind of savings thing in the UK. That one seems like an outside event, but at the same time, a major think tank executive is now running for the Labour Party, and he had talked about taxing on.
Just in 20 seconds, the non-dom numbers have been falling pretty rapidly already. Yeah. How much is that going to accelerate? Almost certainly going to accelerate after the Labour government comes into power, if it were to see that?
Well, certainly my colleagues in the wealth team have been talking to advisors, and while they want to be off the record, a lot of them saying that people are worried about it. It's partly because it's an attitude thing, VAT in private schools, and it's an inheritance tax thing.
Okay. John, great to see you. Thanks very much indeed. Be sure to subscribe to John's daily newsletter, Money Distilled. This is Bloomberg.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have a stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything.
Good morning from our global headquarters in New York. I'm Manus Craney. You're welcome to Bloomberg Brief. Let's set your agenda. Higher and higher, the S&P 500 hits its 25th record this year, while Nvidia tops $3 trillion in market value. Countdown to the ECB, the central bank, is expected to cut rates, with attention shifting to President Lagarde's news conference. And we're live to Super Return. Peter Stavros, KKR, co-head of Global Private Equity, joins Danny Berger live in Berlin. A very good morning. Warm welcome to the show. There's a frenetic energy to some of these markets. We are flatlining on stocks. Don't forget, the NASDAQ powered ahead by 2% yesterday. You saw Nvidia break the $3 trillion market valuation. Apple was up for an 8th day in a row. And so there was this frenetic energy in the Mag 7, which now, if you think three of those components, Nvidia, Alphabet, and Microsoft, constitute 50% of the rally that we have had in U.S. equity markets this year. The narrative is that we're getting slightly softer data that emboldens the rate cut narrative, which underpins the equity narrative. By the way, UBS say the AI revolution will deliver more growth. Keep an eye on Lululemon. They were powering ahead. They delivered a beat and a buyback of $1 billion. So to that extent, we're also keeping an eye on that stock, up 9%. But it's got to say, the last time Nvidia was worth more than Apple, that was in 2002. The bond market, yields rallied for 5 days in a row. We're just pausing for thought now in terms of these markets. We've done 20 basis points, down 20 basis points on bonds in the US. This is an exceptional bullish repricing. The ISM services might have been emboldening, but the prices dipped and the employment numbers also sub 50 in the ISM services numbers. So bond markets have maybe done a lot of their legwork into the jobs report. It is ECB day. The Bank of Canada cut 108.77. October is now alive, let's say, to the extent of 60%. How hawkish will Lagarde be? Will she want to try and reaffirm we are one and done in this rate-cutting narrative? You know, what is the narrative from the ECB? As I say, they are expected to start that cutting cycle today, ahead of the Federal Reserve. And that's going to be for the first time ever. History in the making. Lizzie Burden is on the ground at the central bank in Frankfurt. Lizzie, good to see you this morning. So history in the making for probably all the wrong reasons that Lagarde doesn't want. She didn't really want to be bounced into this cut ahead of the Fed, but here we are. History and circumstances sometimes force your hand. Good morning.
Good morning, Manus from Frankfurt. Yes, she didn't want to jump before the Fed, but it's what it looks like she's going to do, and it's been well telegraphed. It's fully priced into markets. It's almost unanimously expected by economists at this point. A quarter-point cut from the ECB today. Even the most hawkish members of the Governing Council, the likes of Joachim Nagel and Isabel Schnabel, say that they see the grounds to cut today. But that's raised a bit of an eyebrow, really, given the latest economic data. Inflation sticky, wage growth rapid, and surprisingly robust output as well. So as you say, the focus very much on the path ahead. Now, we're going to look to the forecasts, the expectation being that inflation does get back to target next year. But do we see an upward revision for 2026? It would suggest that actually there's a higher bar for cuts going forward. Do we see an upward revision for growth? It'd be good for cyclical stocks. And of course, also, Manus, we're going to listen to the press conference with Christine Lagarde later. Is she clear on the cadence for cuts? It seems like it's going to take a real clarity to create sustainable euro-dollar weakness.
Yeah, I mean, we're intransigent around this 108, 108.25 level. Lizzie, thank you very much. We look forward to the announcement and, of course, that press conference later in the day. So, as you say, the decision's pretty much baked in. It's about the path ahead that is somewhat murkier. Let's welcome in our guest this morning. It is Ludovic from PIMCO. He joins me now. Ludovic, good to have you with me. I look at the data. Wages are hot, 4.7% in the first quarter. The CPI above trend, and the services inflation is also hot, and the three-month average is far from where they really want to be. My question to you is this: should they really be cutting?
Hi, Manus. First, I'm with Allianz, even though we own PIMCO.
My apologies.
On behalf of Allianz. So, yeah, I think, the reason for cutting is threefold. The first is recession risks are higher than inflationary risks. Yes, services inflation is sticky, and yes, wage data is a bit picking up, but there is no wage price loop. And at the same time, we really see the sluggishness of growth once we have a bit less fiscal support. As you know, it's the big story of consolidation. Second, I think it's amazing that the ECB graduates. It's not a teenage central bank anymore. They can take their independence from the Fed. I think that's going to be a massive signal, and I'm quite happy about this. I was a big skeptic on that point because I think the financial cycle is really US focused. We see that everywhere in the correlations among assets. So if they do that today, that also shows a real political independence, because remember, we have elections later this week, and the others may not have done that. And the third reason is very clear. I do think that the path ahead is very gradual. So even if they cut now, we expect still 2 cuts this year. So it's going to be cut, pause, cut, and the terminal rate's only of 2.5 next year. So it's still quite, I would say, still a very conservative monetary policy, and this is really something that is in tune with, I would say, the determinants of growth in the Eurozone today.
That conservatism that you say, and I like the analogy in terms of a teenager, political independence, a spirited mind of their own, detaching from that symbiotic relationship with the Fed. I don't think it's broken, but I think it's a lovely way to portray it. But you talk about the propulsion for rate cuts being much more aggressive in 2025, which then makes me wonder, well, what is so malevolent in 2025, Ludovic?
Well, then the Fed will have started to cut. That is, if Trump doesn't come back and makes a big reflation, from protectionism and discrediting the Fed, right? So that is a very central scenario. But yes, I think the last stronghold, the like bastion, is indeed to make sure that the ECB is not too ahead of the Fed. So that's why the graduation of the teenage years is a bit so important. I think in 2025, by then the Fed will have a bit more forward visibility on its own loosening cycle, and then the ECB can get to a rate cut cycle or pace of 25 basis points almost at each meeting. That's how they get to the 2.5. I think what markets are pricing in right now is a bit cuckoo, if you pardon me. The more than 4% terminal rate in the US is unheard of with 3% growth, and something in the tune of 3% terminal rate, in the Eurozone is also unheard of. So I think they're going to come to their senses, and we do believe that 2.5 is an okay terminal rate for the Eurozone, and that means, a much more cadenced rating cut cycle in 2025 indeed.
What a wonderful way to describe the mispricing in markets, cuckoo. So if we are mispricing the perception of the terminal rate, then what else are we mispricing in the rates market?
That's a good question. I'm often a bit on the edge when it comes to the idea, and you've seen what happens right now. The fiscal policy is very central to everything that is going to be priced in the coming months. So I'm a bit concerned about how markets welcome the fiscal news, especially the fiscal profligacy news. As you know, we are going into a moment where we're going to have this debt sustainability analysis coming from the Commission. We're going to have the excessive deficit procedure list. So I'm a bit worried that some people get antsy or get a bit concerned about the Italian fiscal trajectory, the French fiscal trajectory, and so forth. So that's concern for mispricing on the rate market today. Yeah.
So how sticky is, I mean, the debate that I was having with, not debate, Lizzie was sort of proffering the idea about the sticky inflation in Europe relative to the stickiness of inflation in the United States of America. And a lot of this stickiness comes down to the intransigence of energy as well in the component parts, as well as housing. So how sticky, if I look at the break-evens, I mean, they are beginning to roll down both in the US and in Europe, and we can talk about the seasonality of break-evens, but the trajectory of break-evens is coming down. Does that embolden the narrative that inflation is not as sticky as we're writing about?
That Lizzie was right. I mean, a lot of people are going to look at staff projections today because in every model that I see, including ours, we see this very sticky services inflation part, which is historically not happening. So we see in every model now, if you look at monthly or quarterly modeling of inflation, you have 1.5, even sometimes 2 percentage point of services inflation, and all the rest is at 0, even contributing negatively. That doesn't exist, right? So there is a bit this idea that there will be no gravity for services inflation. I tend to disagree with that. Of course, the good news is second part of the year with a bit less inflation and still wage growth, you're going to have positive real income effect. But keeping this 1.6, 1.7 percentage point of services inflation all through the horizon of forecast is not possible. So I think the break-evens are actually coming to the realization that, of course, services inflation is going to start to, the pricing power of this services company is going to start to wane down as, of course, they cannot continue to have such a good ride as they've had over the past 2 years when it comes to putting a full transmission of their price and the cost to the customers. Yeah.
Ludo, thank you so much for being with us. I'll get the company name correct this time. Freudian slip with the PIMCO. That is Ludo Subran of Allianz. Other stories trending on your Bloomberg terminal this morning. This is what we've got for you. Trafigura posting the smallest first half profit since 2020. That's down 73% from a year earlier. The results signal how the commodity giant is adjusting to calmer conditions across its key energy and metals markets. Trafigura and its rivals have been warning for some time that they don't expect the blowout profit numbers of the past few years to continue. Blackstone is buying France's SEV Group from Triton Partners. The deal values SEV at more than $653 million. That follows a string of similar transactions for Blackstone as it seeks to grow its business investing in energy transition. The billionaire eco-founder of Patron Tequila is among the group of investors who've made a bid to take over Paramount. The group is said to have made an offer several weeks ago, and that's more than the bid from the producer, David Ellison. Coming up, a new member of the $3 trillion club. NVIDIA tops a milestone, the market cap with only Microsoft in its way. We discuss the impact right here. And we have Ella Hodja, head of fixed income over at Newton Investment Management. She joins us to discuss the divergence between the US and Eurozone economies. Context matters on Bloomberg.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be
We're
important.
going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
We're saying to ourselves, wait a minute, if NVIDIA is going to keep running like this, the only reason it should deserve to do that is if it's going to benefit a lot of other companies. And we began to look at what those other companies might be.
ARK Investments, Kathy with us, speaking to Bloomberg's David Ingles at the Greenwich Economic Forum in Hong Kong. But NVIDIA isn't showing any signs of slowing down, is it? Topping out the $3 trillion mark in market value, leaving only Microsoft in its path to becoming the world's largest company. Tom McKenzie joins me now. Tom, good to see you. So what are the odds that NVIDIA will make and take Microsoft's crown? I mean, it just seems the propulsion in this story, it's sort of very, very furious, isn't it?
The march to 3 trillion just seemed inevitable for NVIDIA. And this week, a couple of catalysts coming to the fore. One, of course, you had Jensen Huang over in Taiwan, making again the pitch that this is a company that is not just going to be fueling the data centers of AI, but is going to be in every single laptop in terms of AI laptops, in companies at the commercial level, the business level, in terms of pharmaceuticals, in terms of cars, and beyond. The sovereign play as well, countries building out their own AI capabilities. And he was just stressing how much demand is there and their centrality within that AI revolution. And then, of course, you come yields coming down, expectations that maybe rates drop, and that is broadly, of course, helping as well the broader tech sector. But yes, look, the superlatives come thick and fast for this company, above 3 trillion, overtaking Apple. Jensen Huang's own wealth, what, increasing $5 billion US? $5 billion US in a single day. They've added 1.8 trillion in market cap year to date. Gains for the stock, of course, around 150%. Does it overtake Microsoft? For now, the grind upside for NVIDIA, it keeps going. It's still got a bit of a gap with Microsoft. Of course, Microsoft has its own AI play around OpenAI, so we shouldn't jump to conclusions. But the trajectory seems to be at least potentially on that path.
Yeah, I just wonder what it is that sort of breaks the dam around NVIDIA. Is it one of those people that they deliver the chips to actually coming through with something of a comparable nature? It's that moat, it's the concept of the moat. Listen, we talk about a $3 trillion valuation for NVIDIA, and then we talk about it. It's important to put context around this. ASML is rallying, and they've topped out LVMH, the second largest company in Europe. Again, a propulsion within the chip industry, but it's pretty amazing when you look at 3 trillion versus 410 billion. It just shows you the sort of the European-US tech gap.
Yeah, the dwarf, really, that you see when you put NVIDIA alongside ASML, because NVIDIA can make that in a couple of days in terms of market gains. But look, for the European story, of course, it's significant. You have ASML, the maker of these ultraviolet, extreme ultraviolet lithography machines, these very, very complicated pieces of kit without which you cannot be crunching out the most sophisticated semiconductors on the planet. And of course, they have their own moat around this. They have a monopoly on the most sophisticated machines. They have that market cap. They're beaten, of course. They come above LVMH. We'll see if that's sustained. A couple of lines came through for ASML. We had confirmation they will be delivering one of the most high-end extreme ultraviolet lithography machines to TSMC, of course, the maker and the owner of those foundries over in Taiwan and elsewhere. They've already delivered one to Intel. Bloomberg Intelligence says that could add around 700 million euros to the bottom line for ASML this year, and they expect, the company's already flagged that in the second half of 2025 they see upside in terms of demand for these pieces of kit. So yes, it's a notable mark in the sand, certainly for ASML, but you're right to point out that that gap continues.
Listen, we've seen a number of challenges to deals and technology deals, and certainly challenges coming from regulators. Talk me through what we know about the Microsoft story at the moment in terms of investigations.
This is the Federal Trade Commission now investigating Microsoft's deal. It was an interesting, really intriguing deal. You had this startup, a lot of hype around it, a lot of expectation, a lot of aspiration around inflection. In March, Microsoft did a deal that involved licensing their AI product from Inflection for about $650 million US, but also taking and incorporating most of the staff, including Mustafa Selman, who was the CEO and a former, by the way, co-founder of Google DeepMind. That happened in March. There were some voices at the time who said, look, this may invite scrutiny, regulatory scrutiny. That is now what's happening. The FTC saying they want to know the nature of this deal, what led up to that deal. Interesting at the time when the FTC is also probing Microsoft's connections to OpenAI, the Department of Justice as well, according to the New York Times, looking at NVIDIA and whether NVIDIA has broken antitrust laws. These companies should be expected to fight these investigations. But nonetheless, it does remind us that there is that scrutiny now from the administration.
My favorite line in the NVIDIA story this morning is Gensanity. There you go. Gensanity. Everybody's in. Tom, thank you very much for wrapping up the tech stories as they flow across your Bloomberg terminal this morning. Coming up, we take a look at what else is making headlines around the world right here on Bloomberg. Context matters. Good morning.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg. It's Jobs Day, and Bloomberg has the report under surveillance.
We are seeing the labor market come into better balance.
That foundation for the economy is solid.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
This is not a labor market that's slowing down or grinding to a halt.
Which is why everyone is looking at wages.
Payrolls report, 8:30 Eastern Time.
The May Jobs Report, Friday on Bloomberg.
This is Bloomberg Brief. I'm Manus Cranny in New York. Let's stick with the AI theme. ARK Invest CEO Cathie Wood spoke to Bloomberg's David Ingles on where she believes technology will take us.
The biggest AI project on Earth is autonomous driving. And of course, Tesla is in the pole position for that. We were struck that the Chinese government invited Tesla to work with Baidu's Apollo on its autonomous effort. Now, obviously, Baidu has been working on this for quite some time, but clearly it isn't where the Chinese government wants it to be, and so it's invited Tesla in. So Tesla is our largest position, and we think autonomous driving, that entire ecosystem globally, including China, is going to scale from a revenue point of view from really essentially nothing now to $7 to $8 trillion. And when you talk about revenues, just to put that in perspective, global GDP is about $130 trillion. So this is going to move the needle in the next 5 to 10 years. And half of that revenue, 3 to 4 trillion, is going to go to the taxing platforms like Tesla. Other names that importantly are harnessing AI and are not well recognized are in the what we call multi-omic space. So this is the convergence between multi-omic sequencing, so DNA, RNA, protein, methylation, and so forth, sequencing, and artificial intelligence. So in drug discovery, recursion pharmaceuticals is a very big one. In synthetic biology, twist bioscience is a big one, and then of course we have Palantir in the software space, which is helping companies set up to capitalize on AI. But we're saying to ourselves, wait a minute. If NVIDIA is going to keep running like this, the only reason it should deserve to do that is if it's going to benefit a lot of other companies. And we began to look at what those other companies might be.
Cathie Wood on her opinion about Tesla and obviously their stakes therein. Speaking to David Ingles, quick check on the oil market. Down for 4 days in a row. We're just trying to settle our nerves at the moment. Aramco slashing its prices to Asia for the first time since February. And Prince Abdullah's bin Salman, the Saudi oil minister, says, give it a day or two, reality will settle in. So you got Brent and crude trying to hold the line. They're still down 3.25% this week.
Looking at your portfolio of businesses, it is about resilience. It's about pressure. It's about women. Like,
Yes.
so how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group, where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
From our global headquarters in New York, I'm Manus Cranny. Let's set your agenda. Higher and higher, the S&P 500 hits its 25th record this year. NVIDIA tops $3 trillion in market cap. Countdown to the ECB, the central bank is expected to cut interest rates, with attention shifting to President Lagarde's news conference. And we're live to Super Return. Peter Stavros, KKR co-head of global private equity, sits down with Bloomberg. Good morning. It was a frenetic, furious rally that saw the NASDAQ punch up 2% yesterday. The Mag 7 really was quite furiously lit up. NVIDIA, Alphabet, and Microsoft now constitute 50% of the rally in U.S. equities this year. The NASDAQ, as I say, was up 2% almost yesterday. We're up 0.1% this morning. The victorious in that story, of course, NVIDIA, topping out $3 trillion in terms of market cap. Can that endure? It trounces Apple for the first time since 2002, and Apple is up for the 8th day in a row. There's NVIDIA up 1.125%. Also keep an eye on Lululemon, up 13%. There was a nice beat in the numbers and a buyback of $1 billion. The stock is up 9% and change. Of course, the confluence of the drop in yields also emboldens the growth narrative within the equity story. We're down 20 bips in terms of the week this week. This is a fundamental bullish repricing in the bond market. Even though you had a strong services ISM, prices did dip and employment was sub 50, and that again emboldened the narrative. Earlier rate cuts in more size. To the euro dollar, it's a genuflection really to the ECB today. They'll cut 25 basis points. That is the fundamental assumption. The question is, how hawkish will Lagarde be, and will she intimate it is one and done? And of course, going into 2025, we just caught up with Allianz. They're expecting 4 cuts in 2025. Well, we're counting down to the ECB decision. It's less than 3 hours away. The central bank is, as I say, expected to pull the trigger on the rate-cutting cycle before the Federal Reserve for the first time ever. Lizzie Burden is at the central bank in Frankfurt. She joins us now. So, Lizzie, when we look at the data, you know, inflation, some would say, is stickier in Europe. Wages are hot. They're hot in Germany. They're hot across Europe. You know, should they be cutting at all?
Yeah, there is particular concern from the officials representing Northern Europe, Manus. I've been watching the Governing Council members trickle out of the meeting. It looks to me like they've cast historic votes this morning, but this June cut, well telegraphed, fully priced, and almost unanimously predicted by economists. Therefore, the focus is on the path ahead. How many cuts do we see beyond June? And as you say, the inflation data has been stickier. The wage growth numbers was actually more rapid in recent times. So casting doubt over how many cuts we will see in the future. Traders paring their bets to just 2 now, even though economists mostly see 3. Allianz, as you were speaking to, seeing 4 this year. And actually now, therefore, parallels being drawn between the euro area situation and the American situation. Because yes, the origins of the inflation crisis very different. In the US, of course, it's about that massive fiscal stimulus. In the euro area, it's more about the energy crisis after Russia's invasion of Ukraine. But now they do seem to share a problem, which is that the policy easing now has the risk of being seen as policy errors down the line.
Yeah, well, just take yourself back to 2008. They, of course, nobody could foresee Lehman's. And 2011, they were fundamental policy mistakes at the ECB. Lizzie, thank you very much, Lizzie Burton. We look forward to your coverage through the day. My guest this morning is Ella Hodja. She is the head of fixed income at Newton Investment Management. Ella, good morning. Good to see you. We had Allianz a little bit earlier on saying this is a demonstration of the ECB going first. It's a sense of maturity and independence from the Federal Reserve. I would counter all of that saying, looking at the hot data, should they really be cutting at all?
The credit indicators suggest that policy is already tight. So monetary policy is already tight in Europe. So certainly from that perspective, you can argue yes. And of course, in terms of the inflationary backdrop, things are much better than they would have been, say, up to last year. And so, yes, there is actually quite a bit that warrants this rate cut. And of course, we are sort of way above the neutral rate level for Europe. So I think, yes, absolutely fair.
Okay, so for you, credit is tight. Therefore, the optionality that Lagarde wants, many are saying that she wants to try and close off July being a live meeting and really give herself and the ECB the opportunity to extend and to look at more data. Do you think that's wise, or would it be more instructive to go back to back and then done?
Well, our understanding is that there is a little bit of contention within the Governing Council, so you can see more clearly the first 2 cuts, but what happens beyond that is a little less clear. And so with that in line, they need to buy some insurance and therefore put data on the table. So I think perhaps the nuance today from Lagarde might be a little bit more balanced, as in, okay, so we're cutting, we have enough evidence to do so, but further cuts will be warranted on the back of data.
What do you make of the argument that the longer the Fed remains on hold or higher for longer, as the current situation is, the more it inflicts credit tightness, it permeates from the US into Europe? Do you think that that's a valid argument?
I would say so, and I would say so because when you look at credit card delinquencies, auto loans, when you look at sort of business bankruptcies, but also demand from credit, despite the very tight spread levels that we witness in credit markets, demand for credit has not been resurging. And so therefore, that tells you that there is enough tightness from a monetary perspective in the US. And you know, due to the global nature of financial markets, you do feature some of that into Europe.
So we've been rallying globally in bonds for 5 days in a row. In the US, we're down 20 basis points. Likewise, in the rest of the world, there has been this quite significant bullish repricing. Any sense of exhaustion in that, or will the actual delivery of 25 basis points embolden the narrative for duration in Europe?
Well, we had a cut from Canada yesterday as well, so we'll get this from the ECB today, and so there is certainly an argument to be made. I would say you have to sort of divide the very short term, the next couple of months, perhaps we could be more of a sideways trade. But I think further down the line, over the next few quarters, we actually do like duration. We've been increasing interest rate sensitivity. There's room for us to do more. And that's on the back of the jobs numbers out of the US and the sense that the global growth picture is a little softer than we are sort of giving it on the narrative in markets. So we're certainly taking that view that we might be looking at a softer backdrop over the course of the next 6 months. And therefore, that warrants potentially lower rates, and therefore duration or interest rate sensitivity should be going up here.
And this is very, very clearly laid out by you. You talk about I quite like the way you sort of say we've been lulled into a false sense of security. So this is what you say. Investors have been lulled into a false sense of security over resilience of the US economy. And the main topic is whether the US is slowly gliding to a recession And the jobs trend says so. So what kind of land, I mean, if you look at the data this week, Ella, you know, you get a bit more nervous, and you can understand why treasuries rally 20 basis points, because even within the services data being so strong on the headline, the jobs number within that component, and indeed the wages aspect within that component, both emboldened the need for cuts. So, you know, what kind of landing are you going for? And then the corollary to that is how low do we go in yield? Are we at the beginning of a next big push lower in yields?
Yes, I mean, I think, look, the secular backdrop for yields is a bearish one. Let's just put that on the table. So 2 years out and longer, I think we're looking at a bearish market for bonds. But yes, over the course of the next 2 to 3 quarters, I think the case for lower yields is very strong. And actually, the soft landing narrative that we allude to is much better priced in markets. And what is not priced is this idea that the economy might be slowing down. We're not talking about a drastic sort of decoupling of the economy, but sufficiently softer than what the consensus expectation is, I think is quite possible to us. And I'd probably give that a greater than 50% probability as things stand.
Okay. Ella, thank you so much. As you say, for the next 3 quarters, yeah, you maybe want to be longer duration, and then we can talk about the fiscal adjustments that maybe come to pass in the United States of America 2025. Ella, always great to get your opinion. Ella Hodja there of Newton Investment Management. I want to bring you some live pictures. This is the President of the United States. He, along with his wife, Jill Biden, on the Normandy in Europe, greeting veterans at the Normandy American Cemetery. Now, this is in France, and he will be delivering the remarks at the D-Day anniversary commemoration ceremony very, very soon.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
There are people that depended on a low-rate environment to get exits.
And I don't think that low rate environment is coming back anytime soon. I think rates will probably come down from here, but we are in this environment for some time. I think that's a good thing.
Valuation environment has fundamentally changed, and as a result, private equity sponsors are just going to have to hold companies longer, have to grow into those capital structures, are going to need to take on equity to get some refinancings done, and all that means, it's just math, that returns are going to be lower over the next few years.
I think there is a backlog of transactions that were supposed to happen in the last 12 to 18 months that have been delayed, but they are coming, and we're seeing that in the pipeline today.
You're seeing deal activity come back, certainly over a lower base from last year. And our view is that that's going to pick up over the course of this year into next year, simply because limited partners in private equity want to see their capital back.
In general, just the need for this type of capital is insatiable.
Clarion call for deals. Some of the guests that we got up with at Super Return Conference, where we return to. My co-host Danny Berger is on the ground in Berlin at the Super Return Conference. Danny, great work over the past couple of days. What have you got for us next? Good morning.
Good morning, man. It's wonderful to see you, even though it's from afar this morning. This morning, I'm so pleased to say that we have another excellent conversation. It is Pete Stavros. He is the co-head of Global Equity at KKR. Pete, thank you so much for joining this morning.
Thanks for having me.
So we were just on a panel together, just doing your fireside chat, and there we talked about this idea of over-deployment, that in 2019, $1.5 trillion was the net asset value of assets within private equity. Now that figure is $2.25 trillion, a huge amount of growth. What's going to be the consequence of that growth?
Well, yeah, our industry unfortunately over-deployed in 2021 and 2022, and at a time when rates were lower. The 10-year in the U.S. was about 1.5. Now it's 4.5, and multiples have come down in a result. In the private markets, we're down about 3 turns of multiple, and that's going to mean those vintages are challenged. And what we're hearing from LPs is, because we over-deployed in that period of time when values were higher and liquidity is going to be lower, what that means is LPs have spent all this money and they're not going to get money back anytime soon. So it's creating a more difficult fundraising environment.
So for companies that really suffered of this problem, that did a lot of over-deployment, are we talking about consolidation in the industry? Will some funds struggle to survive because of the over-deployment? The challenge that is to valuations of exiting and to fundraising now?
I'm not prepared to predict that, but I think those vintages and those funds are going to be tougher. To the extent your fund is overexposed to those periods of time when values were higher and people overspent, then that's going to be a tougher fund.
Do you see consolidation in general in this industry if we are going into a period of toughness?
You know, I don't think so. You know, there have been certainly stake sales of private equity firms, but I don't foresee some big wave of consolidation where bigger firms are buying up a bunch of smaller private equity firms.
Right. We also talked about this idea of less IPOs, less exits happening in the world. To what degree is this temporary or a structural shift that just the world doesn't want to be public anymore?
Well, I think part of it is structural. If you look at it, the number of public companies in the U.S. has gone from 8,000 to about 4,500. So companies are staying private longer and, yeah, are not accessing the IPO markets as much as they once did. And so you're seeing this institutionalization of private markets. And that has certainly benefited private equity. And I think it's also benefited the performance of private markets relative to the public markets. You know, if you look at the Russell 2000 and you compare that relative to the buyout universe in terms of growth and margins and return on capital, the private markets today have a stronger portfolio. And then on top of that, private market investors can pick their assets, choose their management teams, pick their entry and exit points, you know, customize their capital structures, design really sophisticated incentive plans, and drive value creation. So I think for both of those reasons, the public markets, I think, are set to continue to, the private markets are set to continue to outperform.
I wonder what to degree this is a healthy trend. Because if you think of everyday retail investors, their access into the market, it's through an ETF. It's maybe they log onto their Schwab account and choose individual funds. What does it mean for the world if they have less of an option, if more of the companies that they can access are just such a small percentage of the universe?
Yeah, well, I think we're going to have to find ways for retail investors to participate in the private markets as this shift, you know, continues and as the private markets continue to gain share. And today, the way it works is, if you, for the most part, if you have a pension fund, your pension fund might get good access to alternatives. But short of that, historically you've been out of luck. And there's a number of managers, including us, who are working on the so-called democratization of alternatives.
So in this world of maybe more muted returns, I know one way that you're trying to squeeze out performance is by looking at the corporate culture. I know you're giving equity to some of your companies, some of the workers in those companies. You're looking at CEO empathy as a measure. Pete, this is very different. You're almost Pete the psychologist just as much as you are Pete the investor. What was the change in mindset for you? What prompted you to start looking at this as a factor of company attractiveness?
Oh, gosh. Well, part of it is how I grew up. My dad was a construction worker, was a member of a union, and he hated his company. And there was, we lived through a lot of strikes as a family growing up, and that left a mark for sure. And you could also see not only it being bad for my dad and his colleagues, but it was bad for the company. I mean, at every turn, if my dad had a chance, he stuck it to the company, believe me. And that is corporate America. 70% of Americans are disengaged on the job. An average company has between 15 and 20% of its employees that Gallup defines as actively disengaged, meaning they are literally throwing wrenches in the machines trying to hurt their employer. So there's a huge opportunity here to help human beings be more engaged at work, happier on the job, and to help investors drive better cultures. In the United States, the quit rate peaked recently at 40%. So 4 in 10 Americans quitting their jobs. What a waste. What a waste of human potential for people to be just bouncing around from job to job. Right. And what a waste for productivity and corporate performance.
And I guess, we can say, look, that sounds really great to be giving folks options, equity options in the company, to be giving them equity. But we're talking about often blue-collar workers, maybe on a factory floor, maybe like your dad. These are complicated financial products for them. And presumably some of them would rather maybe just get a paycheck, a higher paycheck, so they can go on a vacation. How do you solve for that financial literacy issue?
Well, first, on your last point, this cannot be a trade for wages. Right. That is a core principle of ours. You can't give stock and take away wage increases or a 401k match. It's got to be incremental. Now, to your point, this is hard to do. It sounds so easy, like you just give workers stock and they're happy. That's not what happens. They need to be kept informed. If you're a worker and you get given stock, guess what? Your expectations of the company just went up. You tell me I'm an owner, I want to know, what's the business plan? Where are we headed? How can I help? How am I doing? Most people go home at the end of their day job and they talk to their partner and their partner's like, how was your day? How'd you do? No idea. I get no feedback. I don't know how we did. So sharing information, teaching about the business, driving employee engagement, teaching financial literacy, that hard work has to go together with employee ownership. Otherwise, it's not going to work. The magic is getting employees to feel respected, trusted, valued, like they're more than just dispensable widgets. And then you've got a chance to really to rise up and change the culture. Yeah. And to your point, it's the leadership. So with great leadership, anything is possible. You can move mountains. Right. And with poor leadership, it's never going to happen. Which gets to your empathy point.
Right. But Pete, it sounds really wonderful, but that and I'm sure you've gotten this, I'm sure there are people who've listened to this and said, Pete Stavros, it sounds great, but it's nothing but fluff. It is a PR stunt. In fact, I could pull up an example of a KKR company that didn't like being bought. Pimlico Plumbers, recently interviewed by Bloomberg, who look at these sorts of things and say, this is just a PR stunt. What do you say to those skeptics? What do you say to them to say, this is not just an activity, an image of KKR?
Well, I would say there's too much substance. We used to get that. Right. We've been at this 15 years. I would say in the beginning, people would say, oh, you're giving stock. It's a PR stunt. There's so much substance to it. So when we show workers' lives being changed, and not just financially, but the way they feel about themselves and their role in the company, and we have data to show engagement scores and quit rates, engagement scores going up and quit rates going down. Yeah. I think that's kind of over there's no substance. What we do here now is, well, you're doing it, there's substance, but the reason you're doing it is because of PR. And it's I can only tell you inside of the firm, there is no discussion about if we do this, people will think better of us. We're doing this because it's the right thing to do.
And this goes bigger than KKR. I mean, you have a whole charity about this, getting folks to sign up.
Yeah, and I should say, in KKR, this is what Henry and George did from day one. Everyone participates at our firm, whether you're a new executive assistant or you're the most senior investor. Everyone has stock in our firm. Everyone participates. So that's the example that they set. And yes, at Ownership Works, this is about much more than just what we're doing at KKR. We've now got a coalition of, I don't know, upwards of 100 organizations working together on this. So think of not just investment firms and Wall Street banks, but we've got pension funds. We have union leaders working with us. We've got nonprofit foundations, some of whom fund the most critical organizations of private equity out there. We're all working together to try and make this effective.
Pete, unfortunately, we're out of time. We're going to have to leave it on that note, but what a great note to leave it on. Pete Stavros, thank you so much. Again, that was Pete Stavros of KKR. Coming up next, Manus is going to get you covered on all the news you need to know, all the events to set up your day. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Here's a look at the rest of your day. Counting down to the ECB decision, 8:15 a.m. Eastern Time, followed by President Lagarde's news conference. What tone will she set? Jobless claims at 8:30 a.m. Obviously, the last piece that we get ahead of the jobs report tomorrow. Treasury Secretary Yellen speaks on financial stability and AI at 1:30 p.m. Our show starts with NVIDIA, and we close with NVIDIA. Breaking the $3 trillion valuation, we ramped by over 5% yesterday to take us above the $3 trillion plimsoll line. Novavax expecting to be ready for COVID vaccine delivery in the US in September, pending authorization. And Lululemon, get out there and jog. Get your smarts on, extending their gains, raising the full-year profit outlook. You're buying your shorts, and they're doing a buyback for $1 billion. From New York, good morning.
October of 2019, you surprised the business world by stepping down as the CEO of SAP, a very, very large company whose value had more than doubled during your co-CEO position and CEO position. And you took a position with a much smaller, less-known company, ServiceNow. Usually people, when they leave a job, they go to a bigger company. Why did you go to a smaller company?
Well, I saw the future and where it was going. First of all, I want to say I had a great run at SAP, and it was a pleasure taking them from 39 billion to 163 and really inspiring lots of people and customers, and it was a wonderful experience. But after 17 years, nearly 10 as CEO, I was ready to do something different. And when I saw ServiceNow in the marketplace, I knew what it was, and I knew what it could do. And I knew with my background, I was a pretty good cultural fit for what ServiceNow needed to scale it.
So let me ask you, what does ServiceNow really do? Tell me in simple English language that everybody can understand. What do they actually do?
40% of the CEOs say today, if I don't digitize my operations, my company will no longer be viable in less than a decade. So we were the IT backbone for companies all over the world. How do they manage their assets, run their operations, secure their operations, all things digital having to do with IT.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep Green World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
The Fed's sort of backed in a corner here. Probably going to be a little while here until we can see those cuts.
The risk for the chairman is to cut too early before there's any economic weakness, and then having to reverse course.
They're still going to be able to cut in September. Inflation's looking a little bit cooler, and we're starting to see signs that the economy's moderating.
If inflation gets to 2 point something, that gets the Fed and the RAN and other central banks to begin adjusting rates.
With signs like that cuts are on the way, I think it's sort of a wake-up call to everybody that this is actually going to happen. The soft landing can occur.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Bloomberg Surveillance starts right now, live from New York City this morning. Good morning for our audience worldwide, with equity futures just slightly negative on the S&P 500. Coming into Thursday with equities at all-time highs on the S&P 500, on the NASDAQ. Looking for that first interest rate cut from the ECB since 2019. The decision, 8:15 Eastern Time. Bramo, the presser, 30 minutes later.
And it was kind of kicked off yesterday with the Bank of Canada's meeting at 10 a.m. It was the first of the G7 central banks to start cutting rates in what a lot of people presume is the global rate cutting cycle. Key questions are going to be for the ECB, do they signal ahead to July? But beyond that, just what kind of tone do they set in terms of the balance of risks at a time where that's really the struggle right now in markets?
Before we get to that news conference, the next stop on the labour market train, jobless claims at 8:30 Eastern Time. Let's go through the information we've had so far this week. Job openings have been soft. ADP, softer than expected. I think this is a stretch, but let's go with it. ISM services was decent. Employment component, just a little bit weaker. Put it all together, apparently this is the recipe this market wanted to see.
This is a market that is embracing Goldilocks in a massive way. They basically are cherry-picking the data points that highlight a slowdown in a way that causes some kind of weakening in the labor market, but not weakness, as well as some sort of disinflationary trend without the necessarily inflationary pressures in the ISM services report. You say it's a stretch. You're right. I mean, basically, people are picking and choosing the aspects that they want. How much does that continue, and how high is the bar for a downside surprise on Friday's jobs report?
Let's go through the numbers. 185 is the estimate. Previous numbers 175. What's not too hot, not too cold on Friday? Have we figured that out this week?
No, because everyone has a different view. I mean, I think that there are people who say 175 is perfect. Some people say between 125 and 175 is Goldilocks. It seems, though, that we've baked in a lot of Goldilocks and a lot of rate cuts in the past 4 sessions. If you take a look at how far yields have gone in, I mean, we're talking more than 30 basis points for the 10-year, 25 basis points for the 2-year, all of this since the end of May. You're looking at these kinds of shifts. We've already baked in a lot of that. So it raises this question of how much more Goldilocksy can we get?
Big move in the bond market, yields up by about a basis point, 429 on a US 10-year. I'm going to run with that phrase a little bit later. How much more Goldilocks-y can we get? For NVIDIA, there's nothing Goldilocks about it. Let's pull up the name of the pre-market. The name is up another 0.9%. I think it's important to frame this. This time last year, NVIDIA was a $900 billion name. And we were looking at it like, that's a big market cap. That market cap has more than tripled. And I'm going through the names this morning. Microsoft, 3.15 trillion. NVIDIA, 3.01 trillion. Apple, 3 trillion. Alphabet, 2.18. Amazon, 1.89. Those 5 names, individually, on their own, bigger than the DAX in Frankfurt, Germany.
Okay, the top 3 names, NVIDIA, Apple, and Microsoft, account for 20% of the S&P 500, just to give you a sense of that scope. To put into sense the scope of how much NVIDIA has risen, since April 19th, it has gained $1 trillion of market capitalization. That's basically adding more than a Berkshire Hathaway in less than 2 months. That took 6 decades to build, Berkshire Hathaway. This took less than 2 months to add this kind of valuation. It's a freight train, and it really is unclear how far further it has to go.
Yeah, I'm not sure if you want to step in the way of this one. NVIDIA right now is up another 1%. What would you be more nervous about shorting, this one or GameStop? What would make you more uncomfortable? You say this is a freight train. No one wants to step in front of it. What would make you more uncomfortable?
Probably NVIDIA, but at the same time, I don't understand GameStop, so at the same time, I don't think I'd really want to do either. I'll take a rain check on answering
Take a punt on that.
Yeah, exactly.
You can answer that one at home. NVIDIA right now is positive by 1% in the pre-market. Your scores more broadly look a little something like this. We're treading water in the equity market. On the S&P 500, going nowhere. Bond yields a little bit higher by a single basis point. Lisa went through the numbers. It's been quite a run over the previous 5 days. 5 consecutive days of yields falling, down by more than 30 basis points on a 10-year maturity over that period. Lisa and I will go through the numbers again a little bit later this morning. Want to check in on the euro for you, going into that ECB rate decision, 108.80 on euro dollar. That is a slightly stronger euro this morning. That currency pair firmer by 1/10%. Coming up this hour, we'll catch up with Christian Muller-Glissman as tech pushes stocks to another record. Ed Mills of Raymond James as President Biden looks to shore up U.S. leadership abroad. And Yelena Shulacheva of BNP Paribas on the state of the labor market. We begin with our top story. NVIDIA's surge to a $3 trillion market cap, helping to push U.S. stocks to all-time highs. Christian Muller-Glissman of Goldman Sachs writing this. With potentially weaker than expected data on U.S. growth, risky assets might become more vulnerable to rates indigestion. This would make a dovish Fed pivot even more important. Christian joins us now for more. So, Christian, can you tell me your reaction then to the data we've had so far this week and the all-time highs we printed on both the S&P and the NASDAQ just yesterday?
Yeah, it's an interesting discussion you're having on the different shades of Goldilocks. I think a lot of the Goldilocks we got in the last year and a half nearly was inflation coming down with growth being good. And growth actually being better than what most people expected. Whereas now, I think we're having a flavor here of bad news is good news, where growth actually starts to be weaker. And it will be really a kind of very thin line we have to walk here to understand how much weaker growth can hurt risk sentiment. If you look at the macro surprises relative to our risk appetite indicator, they indicate the market is still not fully embracing the slightly weaker growth data. And that makes it vulnerable to a bit of a disappointment. So what we need to understand now is weaker job market data, is it less job openings or is there job losses? And does weaker labor market data actually mean weaker wage inflation, average hourly earnings? These are the things we're watching out for.
We can pack all of that into a single word. We'll hear it repeatedly through the morning. Rebalancing. We've heard from a ton of economists who are talking about rebalancing. Only a very few are talking about real deterioration. And I think the question we've been asking on this program, Christian, for a number of weeks now, in fact, I'd put it at a number of months, is what is the difference between a welcome cooling and an unwelcome deterioration? From your standpoint, with the team over at Goldman, Christian, what is the difference?
Well, we are very much in the rebalancing friendly slowdown camp. And the big difference is, does the consumer remain healthy? Because the consumer is keeping the economy going. the services PMI yesterday, the ISM was strong. And the idea is that you can have a bit of labor market slowing, which then gives you the benefits of that, which means lower wage growth. But at the same time, you don't see job losses, which means the consumer remains healthy, keeps consuming. And I think one of the core reasons why we've been in a more optimistic camp with regards to the economy and also with regards to equities to some extent, where we're still overweight equities, is the fact that the private sector is very healthy. If you look at the private sector financial balance, it's looking pretty early cycle. Everything else looks a bit late cycle. The profit margins are high, unemployment rates are low, output gaps are positive, risk premia are low. All of these things look a bit late cycle, but the private sector financial balance is pretty healthy. And that should mean that the rebalancing is possible. There's a certain resilience for the consumer.
You said you're still positive on equities. Given all of the extreme valuations that you highlighted, the fact that profit margins seem to also be late cycle, what would make you change that view?
Yeah, I think like the longer your investment horizon gets, the more you start to worry a bit about how much equities you want to have in the portfolio. We just wrote a report on that last week. I think if you look on a 5 to 10 year horizon, you need to have pretty favorable macro conditions in the next few years to have equities deliver as good returns as we're accustomed to in the last 20, 30 years. So you need to have AI being a very big success, driving productivity growth, etc. So the longer your investment horizon gets, the more you are wondering the balance between fixed income and equities. The equity risk premium is essentially very low. But because we're late cycle, we always want to stay invested in equities and possibly overweight the longest possible. We found historically looking at late cycle episodes, there's two optionalities you always have: valuation overshooting and releveraging and restructuring, supporting markets, equity markets late cycle. You might say, hasn't that happened already? Hasn't the valuation already overshot? If you look at our fair value model, which incorporates in particular corporate profitability, we actually find the S&P multiple is marginally above the fair value. So it's from a level point of view comparable, of course, to tech bubble levels in certain regards. But because corporate profitability is so much higher, we can justify those multiples as long as that's the case. So the longer your horizon, the more question marks there might be. But in a short run, we are actually comfortable with the valuations where they are.
You talked about different shades of Goldilocks. Let's go there, especially given the question that John's been asking for the past week or so. What does Goldilocks look like in the data that we get on Friday? How much are we sort of seeing the shades of Goldilocks get a little darker, get a little brighter? How do you sort of gauge that in terms of the way that you look at asset allocation right now?
Yeah, I mean, I think, as you were saying, we have to understand how much the labor market slows and what the kind of good and bad things about the slowing is. Like, if we get a payrolls number close to 160, which is where our economists are, and average hourly earnings are starting to come down, that could actually be the Goldilocks sprint that we need, in the sense that you don't have a material slowdown that gets you worried about the consumer weakening, because we had a few data prints, we had a few corporate results that have made the market a bit worried about that. And you do want to see, obviously, the right cost benefit. No, the cost is slow down, the benefit is less inflation. So I think that is essentially what we're looking for. In terms of markets so far, we are starting to see a very subtle repricing of growth. So if you look at cyclicals versus defensives, we've seen a major unwind of FX carry trades. We've seen a bit of a pickup in the VIX, very marginal. So it does seem the market is starting to build a bit of growth risk premium in. So as long as the growth doesn't significantly disappoint, that could allow the market to make progress. So you need to have confidence that the growth picture remains solid, but the inflation is coming down a bit.
Christian, before you go, mea culpa time from me, from my side. I want to talk about the ECB with you. I never thought the European Central Bank would be able to take rates from negative territory to 4% on the deposit rate facility without causing a big downturn in the economy, some real stress in European peripheral markets. We haven't seen that stress in a big way, in any way, shape or form. Christian, I just wonder what your expectations are now for the ECB and ultimately what it means for European debt markets.
Yeah, I mean, obviously the cut today seems to be a done deal that was pre-committed. If you look at the data since, the inflation data, but partially the growth data as well, it's been stronger. So you could say that President Lagarde has a bit of footwork to do today to kind of explain the cut and the outlook. Is certainly likely to be a bit of a hawkish cut. But I think the short story is we are likely to get that cut. And it's exactly to your point, it's going to be a relief. And this is why we've been leaning a bit more bullish on Europe and Euro risk assets, because maybe it's not fully deserved with the macro data, but we are going to get a cut. And that will help certain parts of the economy that are more levered. And to your question, why hasn't there been more pain? I think two things. I mean, there has been pain in small and mid caps and certain areas that are more levered. But I think one interesting thing about the periphery and the remarkable resilience of periphery spreads as well is that these economies are doing really well right now because they're very services driven. There's a lot of travel and leisure. We're all coming into the summer season trying to book our holidays. Italy, Spain, Portugal, they're actually currently outperforming materially versus Germany and France.
Yes, sub 110 euro dollar helps that cause. Christian, thank you, sir. Christian Muller-Glissman there at Goldman Sachs. Appreciate it. I was wrong. I really thought you'd see that stress on the periphery. You didn't.
You know who else was wrong? Literally everybody else. So you've got a lot of company. I mean, I think that was a common belief, and we've all been sort of shocked that we've been able to get off negative rates without much of a hiccup.
You know, the most important thing with the ECB, it's not the decision, it's not the news conference. It's quite unique. It's the hours after the press conference finishes, and you look out for a story. Might come from us. Our reporters will try and break something, I'm sure. When governing council officials just start to leak their own personal views about what they actually thought about the meeting, and you try and establish how much daylight there is between the president and the rest of the governing council.
My favorite part about that is trying to imagine just like sitting there, just sort of seething. How could you? You went out, you did this wrong. There's also been the aspect of cleanup acts that we've seen on a couple occasions. That's been less the case now and more the case of just simply, just want to let you know we're not on the same page.
It's going to be a big fight over July and beyond. I just wonder what that sounds like in the hours after the press conference, the weeks and days after the news conference too. ECB coming up a little bit later. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hakes. Hey, Yahara.
Hi, John. Staying on the ECB, it is widely expected to deliver a 25 basis point cut at its policy meeting today. A Bloomberg analyst poll showing almost unanimous agreement on a cut. President Christine Lagarde saying last month that inflation in the Eurozone was under control following a historic spike. Lululemon shares are rising in the pre-market. The athletic wear company reported first quarter earnings that beat Wall Street estimates and raised its profit outlook for the full year. Lululemon also boosted its share buyback program by $1 billion. But the stock has had a rough year so far, down nearly 40%. And former President Donald Trump is beating Biden on TikTok. The former president got 5.9 million likes on his first video posted to the platform on Saturday. His account now has 5.6 million followers. Biden's campaign account, which has posted hundreds of videos since its debut in February, has just 361,000 followers. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Bizarre state of affairs, right? We want to ban it or sell it, but we want to be on it too.
I mean, also at the same point, baking cookies, UFC's Dana White.
Yeah,
I mean,
two
it's
different
sort of,
visions.
you know, and what are these likes and followers really following for? I mean, drama, policy earnestness.
Yeah, cookies versus UFC. I'm with you. I hadn't thought of that. Big difference. Up next on the program, President Biden making a pitch to save democracy.
At the end of the day, most of us, whether we're Democrats, Republicans, or Independents, believe that America must stand up for what is right. We don't walk away from our allies. We stand with them. We don't let tyrants win. We oppose them. We don't merely watch global events unfold. We shape them.
That conversation just around the corner. Live from New York City this morning. Good morning.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Live from New York City, coming into Thursday at all-time highs on the S&P 500. Equity futures shaping up as follows. Unchanged. Yields up a single basis point on a 10-year, 429. And in foreign exchange, counting it down to the ECB, euro dollar 108.81. Under surveillance this morning, President Biden making a pitch to save democracy.
At the end of the day, most of us, whether we're Democrats, Republicans, or Independents, believe that America must stand up for what is right. We don't walk away from our allies. We stand with them. We don't let tyrants win. We oppose them. We don't merely watch global events unfold. We shape them.
Here's the latest. President Biden is in France to commemorate the 80th anniversary of D-Day. The president will then meet with Ukraine's Zelensky ahead of a speech on democracy and freedom tomorrow. The trip highlighting the importance of foreign policy for the Biden campaign ahead of this month's debate with Donald Trump. Ed Mills of Raymond James writing this. In the upcoming election, if it is defined by geopolitical issues, Biden is likely to lose. We expect the Biden campaign to work to neutralize the multiple geopolitical hotspots and shift attention towards Trump, raising questions on his temperament and leadership during crisis. Ed Mills is with us around the table. Ed, good morning to you.
Good morning, John.
Let's start there with foreign policy. Where does that rank just in terms of voter concerns this year?
I think it's probably one of the biggest drags on Joe Biden's reelection. If you go back and you look at right track, wrong track of the country, favorable, unfavorable ratings, when you go to see where it shifted from Biden having a net favorable rating to a net unfavorable rating, it was back in the awful withdrawal from Afghanistan in August of 2021. He's not recovered since. And when you look at Trump voters, one of the things that they're saying is that there wasn't the same level of geopolitical issues under Trump. And so, fear or not, that's driving support for Trump. And it is pulling down the polling numbers for Biden, especially among key parts of Biden's base, younger voters.
Do you think it's execution or ideology? Because what we see from Biden, he's proud of it. He talks about alliances, allies, multilateralism. What you hear from the former president is a form of isolationism. And that's going right the way through some parts of Congress as well. Which one is it?
I think it's both. I mean, America First, which is Trump's saying, is something that's really popular with his base. It's part of populism politics. That is a core part of kind of the ability to appeal to a broader swath of voters than Republicans have traditionally done. There's a big bifurcation. You look at the Senate, which is his, more senior, kind of been in D.C. longer, fully supportive of Ukraine and was overwhelming in their support for their last aid package. It was the House of Representatives, the newer members to D.C., that are more aligned with President Trump, more aligned with the MAGA movement. And those were the ones that really did not want to see kind of the funding that went to Ukraine, and that got passed a couple months ago.
Tomorrow, President Biden's going to be in France. He's going to be there for the ahead of the G7. And he's going to deliver a speech on the anniversary of D-Day. I'm curious about this speech on democracy and freedom. It'll be music to the ears of a lot of the European leaders there. How will it be received, do you think, in the United States?
So I think it's important to remind the world of America's power. I think it's important to remind the world of the accomplishment that occurred 80 years ago. I'm also looking at the fact that we are going to commemorate and celebrate the 75th anniversary of the NATO alliance. And so in an American audience, I still think that American leadership is important, but there's also kind of It's the economy. It's the inflation. It's the day-to-day harder kind of existence as voters that look at this more as a nice to have than a necessary, because we have not had that same level of threat that we felt in the immediate aftermath of World War II. One of the questions I get a lot at Raymond James is, we're celebrating the 75th anniversary of NATO. Are we going to celebrate an 80th, especially if there is a second Trump presidency? What I tell them is that something that was under the radar in the defense authorization bill last year was Congress tried to future-proof this. Congress is concerned about the NATO alliance and strip the president of the power of unilaterally withdrawing from NATO. So Congress cares about this, probably more so than the average voter.
But there isn't going to necessarily be a galvanizing kind of impetus from the idea of talking about democracy and freedom. And this is, I think, a big divergence from the last Trump-Biden mix-up, where basically you had the threat of losing democracy as somehow galvanizing voters to get to the voter booth. Is it going to have the same appeal this time around?
So I think there's probably going to depend on how much the Biden campaign tries to execute on this strategy. And I'd also say how much Trump talks about it. To the extent that he is tweeting out in raising kind of re-awareness with January 6th, that was something that helped out Democrats in the lead up to the midterm elections. The Biden focus on democracy didn't rank high with voters, but on the margin, and this election is going to be decided very, very small margins. Biden is going to try to shift the attention to Trump, shift that attention to what we were talking about as it relates to the temperament during crisis, leadership of the United States, and saying, for the next 4 years, who do you trust more? You might not really have liked the geopolitical risks that have existed over the last several years, but going into the future, the next crisis we hit, who do you want in the Oval Office? Biden is going to make the case that it should be him.
Could we just tease out your thoughts on NATO just a little bit more? We've had the Dutch Prime Minister on this program with us, Mark Rutte, and Rutte's made the point that the former president was right. And I'd love your perspective on this. Do you think he undermined the alliance or reinforced it?
John, it's a great question, because what Donald Trump's #1 issue with the alliance was the members of the alliance not paying their fair share. And over the course of the last, 6+ years, you've seen a dramatic increase in the kind of other members besides the United States increasing their dollar amounts. And so one of the questions going forward is, how much does a threat to the alliance really come down to a transactional discussion? And if you get up to that 2%, and maybe look at kind of the 2% that was not spent over the last several decades, that shifting that dollar burden, and it goes back to that conversation of a lot of Americans support NATO. A lot of Americans want to be the world superpower. I just don't think they want to be the only ones paying for it.
Ed, well said. It's good to see you, as always. Ed Mills there of Raymond James. Very, very difficult waters for the president to navigate over the next several months.
Yeah, it's mind-spinning, especially because it's hard to know whether it was policy or whether it was actually just the way he carries himself. I mean, that's sort of the uncertainty that I heard there from Ed, that it goes back to an actual policy shift from withdrawing troops from Afghanistan. But then there's a question of just, an older person who isn't necessarily projecting strength the same kind of way.
Policy or execution, Bramo, because the former president wanted to do the same thing.
I know.
He got the train going, the wheels moving.
Yeah, and if you're isolationist, shouldn't you welcome some sort of departure from some of that policy? You're correct. It's about how it's done, probably more so.
Coming up on the program, we'll continue the conversation on the financial markets. We'll catch up with Orlando Bravo and Toma Bravo on private equities investments in AI. Look out for that with Danny Berger in just a moment. From New York, this is Bloomberg.
names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Equity futures on the S&P 500 just about unchanged. The fireworks yesterday. Big rally, record highs on the S&P, on the Nasdaq. The team at Bloomberg still counting 25 all-time highs to the close on the S&P 500 so far this year. Can we make it? 26. Turn a page and get to the bond market. 2-year, 10-year, 30-year. Bramo's still counting. 5 days of yields declining on a 10-year. Down by more than 30 basis points over that period. Lisa, that's quite a run in the bond market. Yields lower across the curve.
It's a lot of rate cuts that are suddenly being priced in. Again, we go back to how much more Goldilocks can it get? How much more can this payrolls report confirm the idea of some sort of softening in the labor market that's not over soft, that can confirm this orderly and lovely decline in yields that also comes with the rally that you just mentioned?
We want it just right. We're going to try and work out what just right actually is on Friday. Get people to give us a number. What is just right on Friday morning at 8:30 Eastern time? Let's finish on the euro. Euro dollar 108.76. Just a little bit of euro strength going into that ECB decision that we'll talk about in just a moment. Under surveillance this morning, a busy week of data continues. ISM services expanding the most in 9 months after downside surprises to ISM manufacturing and job openings. The median estimate in our survey expecting today's jobless claims to come in at 220,000. The estimate for payrolls on Friday is still 185K. We mentioned this briefly 30 minutes ago. Let's do it again, Lisa. It felt like a stretch yesterday. If you told me the headline ISM would have come in the way it had done, I wouldn't have expected yields to drop and equities to go off to all-time highs at a close, but that's what happened. And the focus seems to be on the employment component of the ISM services read that came in a little bit soft.
This is, when you say what is the recipe for Goldilocks, this is a stir fry. It is not a cake. You can basically choose the things that you want. You can throw them in and it's not going to destroy it.
Just chuck it in the wok.
Exactly. And it just comes out and it tastes good versus actually needing the correct amount of baking soda to offset and salt to offset the flour. And that's kind of where we're at right now. People are choosing the ingredients they want, throwing it in the pot, and what you're getting is a 25th record high on stocks while also getting a lovely decline and rally in bonds.
It's a low-end stir fry because this market's easy to please. Is that fair enough?
It's a stir fry being fed to algos, but whatever.
Something like that. Probably. An ECB rate decision due out in just under 2 hours' time. The central bank widely expected to cut interest rates for the first time since 2019. President Christine Lagarde giving a news conference 30 minutes afterwards. Investors looking for clues on the path forward from here, because this is not about June, which I know sounds really strange to those of you that might not follow the ECB, but for most people, they assume the rate cut is done and you'll see exactly that at 8:15. This is about what happens beyond July, September, and further out.
You mentioned all the discussions afterwards, the leaked stories from disgruntled policymakers on the ECB Council who don't feel like their view is accurately reflected. What we've heard in the past month is people were uncomfortable with pre-committing to a rate cut at all this month. So now how much do you get pushback into sort of, yes, data dependency, yes, we're not going to give you any information? That's what I'm curious about. Is that going to count as hawkish to basically give a nod to those people who are saying it was a mistake, we've got to be just as opaque as the Federal Reserve?
Lagarde's going to be interested in this news conference. I think it really is one to watch a little bit later. Let's turn to this. President Joe Biden is in France, marking the 80th anniversary of the D-Day landings at Normandy. during World War II. Biden is then expected to meet with Ukraine President Volodymyr Zelensky tomorrow. The president will deliver a speech on democracy and freedom. We just caught up with Ed Mills of Raymond James. It just feels like the president's stuck between a rock and a hard place on several of these issues right now. He's going to talk about the importance of multilateralism, alliances, democracy, supporting our allies at a time when what plays well domestically in America, increasingly you just get this sense that it's isolationism at the moment.
Who's his audience? That would be my question for this. You're going to get a complete round of applause from European leaders who are very worried about the former President Biden, former President Trump. We heard about that at Davos extensively. But at home, there is a question of whether it's isolationism or whether people just don't care. It's sort of like benumbed by the sort of inundation of it's going to wreck your world and all of these potential threats. There are a lot of people tuning all of that out and just looking at their empirical experience at the grocery store, at the gas station, just in their everyday life beyond any messaging, because there is a lack of trust. And you can feel that in all the polls. You can see that in terms of just consumer sentiment.
Top two issues repeatedly in all the polls: the economy, immigration. 1 and 2, 1 and 2, 1 and 2, repeatedly. The race is on to invest in artificial intelligence. We saw NVIDIA make a big move yesterday again. Public names like that stock absolutely soaring on Wall Street, but asset managers are looking for other ways to get involved. Blackstone CEO Steven Schwarzman telling a German newspaper the build-out of AI will need $1.5 trillion over the next 5 years. Bloomberg's Danny Berger is with Orlando Bravo of Thoma Bravo in Berlin. Danny, good morning to you.
Good morning, John. Thank you so much. And that is exactly part of the mood here at Super Return. What does this industry do with AI? Do they care about AI? We have the perfect man for that. As you say, it's Orlando Bravo of Thoma Bravo. Orlando, thank you so much for joining this morning.
Danny, great to see you.
So if you look at these public markets, it used to be a frenzy over all of AI. If you mention AI in an earnings call, your stock goes to the moon. Lately, something has changed. It's now NVIDIA's the winner, and we're more skeptical about other companies' abilities to monetize AI. So did we get over our skis in the promise of AI right here and right now?
Well, Danny, I can give you the enterprise view of AI, right? The business view, not the consumer view. Now, if you look at the software landscape, $10 trillion of market cap in software publicly traded companies today, about 1,000 companies. Some of those software companies have been providing AI solutions to their customers for decades. In fact, some of those companies are pure AI companies. Now, let's differentiate that. When you talk about Gen AI, right, the new form of technology in AI, this is what's going on today. Many software companies have produced and delivered and introduced Gen AI solutions to their customers, but they're not charging for them. They're including that in the bundle of their products.
Is that a problem? We saw that in Salesforce. That stock sold off because margins on that essentially zero. Do companies need to get better about finding a way to monetize this?
Yes, they do. But at the same time, the software business has become, you have to continuously add value to your product, not only to fend off competition, but to upsell your customers. So this is a good development overall. Today, we have $25 billion of revenue coming from our software companies, and 75% of those companies have released Gen AI solutions to those enterprise customers.
But what you're talking about, it's not necessarily extra profit because they're not charging for it. So that promise of huge outsized profit, is that a little bit misguided? Because it sounds like you're saying it's just a continuation of value offering.
But you should be able to monetize it later. The key is if you really run an efficient operation, you take all your engineering talent and your product management vision for that engineering talent, you do have to move resources around.
How patient should we be for that? Because these public markets aren't being patient. What should be the timeline we give companies to figure this out?
The investors, and we as a big investor in software, a private investor in software, we always look at the P&L. And is the company achieving the level of earnings that we set out to achieve? And if we are, within that, the company can create and innovate and move around resources to fit what they need.
Okay. In software in general, Orlando, I mentioned Salesforce having a bit of a tough time. Not just the issues with AI, but some concerns there that maybe sales weren't as good. Workday had something similar. In the private markets, you see Vista taking a huge write-down, $3.5 billion on one of their online learning platforms. It's these pockets of software stress. What's going on?
What happened was, you know when this happened? Q2 of 2022. That's when we first saw a big drop in new business generation by these companies. A drop in bookings. Now, always as an owner, you think about what can you do about it? What we do about it is we protect the P&L. We have to come in and cut cost again to protect the level of earnings that we set out to achieve in these companies. Now, those pockets of weakness are also related to the business model of these companies. You look at Gen AI and you look at a technological shift in the enterprise software world, but also a business model transition, and people don't talk enough about that. Companies that charge by the user are going to be more challenged than companies that use other forms of pricing.
Are you still in cost-cutting mode now?
We always are protecting the P&L. Not right now. We had to do that again in 2022, and it's much better to be early so you don't have to chase your earnings. That way, if the environment improves, you can come back and invest, and if the environment stays the same, you can basically run your business profitably.
I have to be honest, Orlando, when I've talked to a lot of folks here about AI, a lot of people have said it's not as big of a topic this year. Maybe it was last year. We're not really thinking about it that much. Is this industry behind in having an AI game plan? Do you think all of these various private equity companies with portfolio companies, do they need to have a plan for all of them?
You need to have an AI game plan. In fact, in the SaaS era, which really got started in 2010, a bit before that, we used to say that every company needs to think about becoming a software company or their digital side of their business. Now we say that every company needs to become an intelligent software company. And if you look at the buyers of our companies, all the exits we've had over the last 18 months, many of them are industry buyers that are looking to transform their companies through software.
But isn't there some of it that's a gimmick, Orlando? Like, I don't need my refrigerator, for example, to have AI, do I? I mean, isn't some of this we're selling a dream that's not really there?
Sometimes you are. That's where there's so much value in the software incumbents. There are two reasons for that. The software incumbents are working with their customers, thousands of them, sometimes the entire Fortune 500 customers, on solving an important business problem today that they have in a given use case, in a given horizontal, in cybersecurity, or in a vertical. Those are the companies that are in the pole position as a trusted advisor to develop Gen AI solutions that actually add value to those customers. And secondly, and really important, something became very valuable in software enterprise, and that is data. Proprietary data. Many of the companies you mentioned are sitting on proprietary data that they can use from their customers that can be used to develop Gen AI solutions and train these models.
Well, that huge, vast treasure trove of data, it's no secret. It's something that regulators have looked at with consolidation in this industry. An investigation is opening up now. We heard this today with Microsoft and OpenAI. It's been a lot of concern about antitrust. How big of a headwind is it to you? Have you had to approach investing differently given what's happening down in D.C.?
Very differently. And we take a practical view towards antitrust and the regulatory environment. This is the thing. It's a fact-based approach. If you're a seller and you believe you can add a lot of value by selling that company at the right price, and if you're a buyer and you think you can add a lot of value by buying that company, you just have to appreciate that there is a public policy underpinning environment towards this, and you have to live with it.
So are there deals you haven't done because of this?
Most of the time, no, because if your facts are right, you have to go forward with that and being willing to be creative, collaborative with the regulators.